9 a.m. here in New York City on this Wednesday, December 4th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. equity futures. They are gaining after the S&P 500 hit a new record high, ahead of remarks by Federal Reserve Chair Jerome Powell that may provide some clues on whether the central bank will cut interest rates in December. The remarks will be the last from the Fed chair before the FOMC decision later this month. Now, this morning, ADP private payrolls showed hiring remained firm in November. Companies added 146,000 jobs.
Plus, shares of Salesforce powering higher after the top seller of customer relations software reported revenue that topped the street's expectations. It also signed more deals for its AI products. The company launching its AI product Agent Force in October, and investors are hoping that the AI strategy will help lift results going forward. Meanwhile, AI demand is lifting shares of chipmaker Marvell as the company delivers an upbeat earnings forecast.
And General Motors will take a $5 billion hit from charges and write-downs tied to its troubled operations in China. The actions follow years of turmoil in its once profitable business in the world's largest car market. China has made efforts in recent years to support its domestic automakers in a bid to make them dominant players at home and abroad.
Investors are awaiting remarks from Federal Reserve Chair Powell at a moderated panel today, looking for any clues on the central bank's path forward on interest rates. Joining us now, we want to bring in, we're going to have him in a second. Matt Lazzetti is going to join us here in just a second. But first, we want to get to the latest moves that we are seeing here in the markets, Brad, because we're coming off record highs. We talked about the fact that there's just this unrelenting momentum here to the upside. Lots of excitement and euphoria sweeping the street just about what a Trump administration, incoming Trump administration, what exactly that entails and how big of a boost, how big of a driver that is going to be for the markets. We've also talked a lot about some of those seasonality trends as we enter December. Historically speaking, December tends to be a very strong month here for the markets. And then when you also couple that with the fact that it's an election year, historically speaking, we do tend to see outperformance in election year. So lots of talk right now leading up to that Santa Claus rally, which is that last week of December following the holiday, the last 5 trading days, I believe, of December, first 2 trading days of January. So lots to talk about whether or not we're going to see that Santa Claus rally this year. But things are looking good so far.
Things looking good, and overall it seems like there's some sentiment in the markets and certainly some of the larger investment firms about this grind higher here. UBS, that is a note that comes to mind from yesterday as their chief investment officer for the Americas expects bouts of volatility, corrections in the year ahead, but continues to believe that the S&P 500's next leg up to their December 2025 target of 6,600 will be fueled by solid economic growth. We're continuing to get some data prints over the course of this week, really pertaining to the labor market in the half of that kind of dual mandate for the Fed. And then also the Fed's easing is what they're going to continue to expect, plus AI advancement, which is perhaps one of the larger stories rattling through the markets here today off of Salesforce's results that we broke down for you just very briefly at the top of the show. Within the U.S. equity markets, they're continuing to favor, though, and it sounds like there's a lot of favor still within technologies, utilities, and financials as well. If I had $1 for every time somebody came on and talked about their strategy, and part of that strategy really lingering in and really being based around financials and the big banks, then that would make me a rich man at this juncture. But a lot of investors hoping that financials will make their coffers a little bit more fattened, especially going into next year with some of the projections that we have heard thus far.
All right, well, Brad, investors are awaiting remarks from Fed Chair Jay Powell at a moderated panel later on today, looking for any clues on the central bank's path forward on interest rates. We have Matthew Lazzetti, Deutsche Bank's chief U.S. economist, joining us here at the desk. Matt, it's great to have you. So there's been this debate now for quite some time, just what exactly the Fed should do, what it's going to do here in the meeting in just 2 weeks from today. What do you think makes the most sense at this point?
Yeah, so I think most likely they deliver a 25 basis point rate cut. We've heard from several Fed officials already this week. Governor Waller said that he leaned in that direction. New York Fed President Williams also seemed to indicate that that's where he was leaning. Most other Fed officials have essentially left optionality on the table. I think it's important. We do have key data releases coming up. We have the jobs report this Friday. Next week, we have the CPI inflation report. We have a retail sales report ahead of that meeting. So all those, I think, will go into the decision. But at the moment, it seems likely they deliver a 25 basis point rate cut. Beyond that, I think you see Fed officials beginning to stake out a view that they might want to begin to skip or slow the pace of rate cuts.
Should they, though, deliver that 25 in your view? Does that make sense?
I think they can. I think that they are still have a restrictive stance. I think that stance will continue to put downward pressure on inflation. But beyond December, I think it's a much tougher call, and I think you'll begin to see, I think, a greater disagreement from Fed officials. If you take a step back and just think about what the economy has looked like, growth has been solid, 2.8% in Q3, tracking close to 3% in Q4. The labor market, after slowing during the summer months, has shown some resilience, as you mentioned, with ADP. And inflation, importantly, has been higher than anticipated over the past several months. All that sets up for the Fed probably cutting rates less than people expect.
And so less than expected, what does that mean for your purview? Because a lot of economists seem to be in the camp of we might see one cut per quarter next year.
Yeah, for me, that is not the most likely outcome.
What's the most likely?
I think if you look at what's happening with the inflation data, essentially core PC is up 2.8% year over year. It's the same over 3 months. We've seen very little progress over the past year. And we expect that inflation is going to remain sticky above 2.5%. So after cutting rates by 25 basis points in December, we expect that the Fed undertakes an extended pause. We expect no further rate cuts throughout 2025, essentially the Fed keeping the Fed funds rate at 4.3%. Because the economy does not need lower rates at the moment. The consumer remains resilient and strong. GDP growth is resilient and strong. We expect that the labor market bounces back next year.
That's with the absence, though, of what we could potentially see from the incoming administration. And what would throw off that projection that you just laid out of no cuts in 2025 if we did see the Fed have to monitor exactly what some of those policy moves from now the White House and Congress after what we saw in the 2024 election and a red sweep more broadly?
Yeah, there's lots of uncertainty about where policy is going to end up. We expect that tax cuts get extended and we get modest additional tax cuts next year. That'll help lift demand, lift growth, support a strong labor market. And therefore, that part of the policy debate, I think, supports the Fed remaining on hold for longer. I think that the trade war and tariff side is a bit more difficult, I think, for the Fed to navigate. One, it'll lift inflation. That's not a good outcome from the Fed, given that inflation is already above their target. But at the same time, it will tend to weaken growth. It'll weaken sentiment and also damage the labor market to a certain extent. And so the Fed will have to navigate what this adverse supply shock is. If you get a stronger trade war that really rattles markets and damages growth to a greater extent than we anticipate, that would be something that could bring about greater Fed rate cuts.
How likely is that in your view?
I think it's certainly possible. I mean, when you look at what the administration has outlined heading into January, it has been aggressive approaches to tariffs. Our view is that they start off smaller, they start off more targeted, and they phase them in over time. I think that fits with indications that we got from Treasury Secretary Bessent that's incoming. That was kind of the approach that he wanted to see. Robert Lighthizer, recent reports are saying that he might not be part of the administration. He's a real trade hawk, and so I think that kind of fits. But look, there's a lot of uncertainty here, and I think we could get more aggressive approach to trade.
We've spent a lot of time focusing in on the consumer this week, especially as some of the consumer juices are flowing, all the sales, promotions that are in the market right now. But what does that spell out to you about and kind of how you are classifying the consumer right now when you have such a value conscious and a consumer that is saying, hey, I really don't want to purchase something at full price, much less if I don't see a promotion on it that is upwards of 40 to 50%.
Yeah, I think it's been a period probably over the past year where we've seen this real maybe discordance between what consumers are saying and maybe some price sensitivity, and then you look at the macro data and it's always strong. So when you look at retail sales, consumer spending we got last week, it's been resilient. We got auto sales last night. Those were also strong. And so I look at a consumer that still has a resilient labor market, an unemployment rate of 4.1%, solid income growth, a savings rate that was revised up materially, and net worth to income ratio that is near record high levels, and an aggregate consumer that looks pretty solid from an outlook perspective.
Now, what do you think? I mean, maybe it is tariffs, going back to what we were just talking about a minute ago, but what is the biggest risk, do you think, or challenge ahead for the economy in the new year?
Yeah, I guess two sides on this. We're not out of the woods from the labor market yet. We came out of this period over the summer where the unemployment rate was rising more materially, payroll gains were slowing. We've gotten some better data over the past few months, but I don't want to suggest that all those risks are gone. You still have an economy and a labor market that is reliant on low layoffs and a low hiring rate, so low hires and low fires. If layoffs pick up, that picture changes. On the other side, inflation, I think, is just at risk of remaining stickier than many anticipate. We've upgraded our inflation forecast. And one thing that I think nobody's really talking about, but the potential for the Fed to think about having to hike rates next year, I think is greater than a lot of people anticipate. Taking a step back, we just have a lot of policy uncertainty that's there. And so the possible outcomes from a monetary policy perspective, I just think are much wider than many people are anticipating.
What's the setup then for a hike? What would have to shift so dramatically for the Fed to say we actually need to hike interest rates once again?
I think you need to see inflation that is accelerating to 3% and above. We're not far from there. We're at 2.8% for core PCE. You need to see the concerns about the labor market completely dissipate. So the unemployment rate probably has to come back down, payroll gains have to stabilize and move higher. And growth just needs to be where it is, kind of close to 3%. So the data is not, I think, far from that for a market that is, I think, completely discounting that as a potential outcome.
Matthew Luzetti of Deutsche Bank, thanks so much for taking the time here with us this morning. Appreciate it. We're watching Salesforce this morning, the company beating third quarter revenue estimates and raising the low end of its revenue guidance for the fourth quarter. Investors are closely monitoring the company's AI developments, including its AI chatbots. Joining us now, we've got Brent Thill, Jefferies senior analyst. Brent, great to have you here with us this morning. You're raising your price target after these results. Just walk us into the thesis and what shifted dramatically.
Yeah, good morning. The overall core business continues to stabilize and signs of acceleration, number one. Number two, they finally have caught on to the AI wave. They're late with Agentforce, which shipped at the end of October. But the checks have been really good. Some of the partners we speak to have said this is the best product they've seen in 5 years organically from Salesforce. Salesforce has had a history of acquiring products, not building. So this is a great sign in terms of organic innovation after they took a diet from M&A. I'd say third, as you go into next year, enterprise IT spend should continue to improve. Obviously, with the new administration, you have effectively a better backdrop for spend and potentially M&A. So if they want to do some tuck-in deals, that will help. But I think it's, overall, you have a balance of a company that should accelerate revenue growth into AI and margins that are still well below that of their peers. So their margins are going to go from low 30s to high 30s, still big leverage. So you have leverage on the top line with accelerating growth. You also have leverage in margin. And you have now signs, again, that they've actually given organic innovation to the story. And that's like, we just haven't seen that Salesforce for a long time.
Yeah, Brent, that's very interesting. And I guess just given the feedback, just anecdotally, that you were just referencing some of that excitement on the street, what do you think that tells us just about the strong, I would think, the positioning here of the pricing power that Salesforce is in then going forward?
So it's really early in AI, and there's a lot of fear because if you think about their model, it's a seat-based model. So if you buy one seat of service and you're in a call center, you want to buy one seat. If you're in sales, you pay a fee per seat. Well, what happens when all the agents do your job for you? They start answering your calls, they start answering emails. How do you price? So today, these Agentforce AI products are incremental because companies aren't ready to reduce headcount yet. All the checks we have are still a couple of years away. So if you have 100 people in sales or 100 people in a call center, you're going to add Agentforce on top of that to see what you can get in terms of productivity, and then you start removing seats. So the pricing's a little murky, to be honest. I think it's additive in the short term. There's some numbers that are out there that are way too high from our friends on the sell side that are just making up numbers, honestly. And I think it's way too early to make the call. But it's going to be additive in the short term. The question is, does it cannibalize seats? Because I don't need as much Salesforce if the agents are doing the job. So then they have to go to a transaction model, not a per seat model. So there's a lot of open questions in software pricing, packaging, go-to-market. No one really knows yet. And again, we're at the kind of the beginning of this. Right now, it's additive, so it's not going to cannibalize in the short term, but we're watching that long term.
Brent, it got brought up in conversation earlier this week, and it's kind of along the lines of what you were just mentioning. Companies that are more in the experimental phase of some of their AI spends versus where we'll get to the normalization phase of some of the spends for knowing how they can actually use long-term and plan to use long-term some of the agents even that they're working with Salesforce on. How far out do you think we are until that point where investors can then have a better baseline sense of how they should kind of run the calculus or bake that into the numbers?
Yeah, I mean, we're still a long ways away. I mean, the way I describe it is if you have kids and you watch the movie Despicable Me, you know what these little minions are. They're hard to manage, and the little yellow guys that run around. And right now, all these AI agents are minions. No one really knows how to manage them, what they're going to do. Are they going to behave? Are they going to put their elbows on the table at dinner? But right now, it's really difficult. And so I think right now we're in a early test phase. What you see, again, is AI test deployments in very small segments of corporations. No one's gone all in. Most of the companies that have gone all in aren't really achieving success because it's really difficult to do it with new technology. So right now we're in the minion phase. How do you manage them? How do you keep everyone in line? And then we're going to figure out over time, that deployment. A lot of firms that we talk to are 10% kind of test deployment, and they want to go to 90% over the next three to 5 years. We'll see. And there's different forms of AI, right? So you have application AI, you have security AI, you have developer AI. I'd say that the most adopted AI today is in developers writing code because it's a distinct task. But if you go into Microsoft Office, it's huge. Word, PowerPoint, Excel, Outlook. There's a huge canvas to cover, so it's not as big of an adoption. So it really depends. And again, you can't measure AI, overall. For Salesforce, again, I mean, the product just launched at the end of October, so we're really, really, really early.
Right, you're really speaking my language. Despicable Me has certainly been on a replay at our house over the last several weeks. I want to get to Amazon because it's another stock that you cover very closely. Our very own Madison Mills had a chance to speak with AWS's CEO, Matt Garman, last night just about the company's new AI capabilities, the future of AI growth. I want to play a quick soundbite and get your reaction to what he told us on the other side.
Our view is that it should grow the entire size of the pie. And that really is our goal. We think that we're at the very early stages of where the generative AI market is going to be. And we think that there is explosive growth ahead of us. And we think there's more than enough growth for more than one player out there.
Brent, I'm curious what you make of those comments and just how investors should think about where Amazon sits relative to NVIDIA, some of the other larger players within the space, and the ability here to compete going forward.
Amazon's in an amazing position. You want to stay long the stock. Amazon and Microsoft are our two best enterprise AI plays, and then Meta and Google for the consumer. So we have a simple AI playbook. Amazon owns the majority of the cloud market. They own the compute market. If you look at Salesforce, the entire Agentforce business is built on AWS. So their core compute business is going to benefit. Well, Salesforce can sell a product. They have to run it somewhere, and they run it at AWS. A lot of these companies are going to run their AI at AWS, and they're also run it at Microsoft. So they're both going to benefit in a big way. Google will also have some benefit. So Amazon's in a great position. They're reaccelerating their cloud business without AI. Right now, core workloads are going back to the cloud. You're seeing numbers go higher. Their margins have been off the chart. That's the majority of the company's operating profit is at AWS. And so we are super bullish about where they're going with the business. And AI, I think they're behind, honestly. I think Amazon's behind from all of our sources. And that's okay, because again, as I said, we're really early, but they got to figure it out. And everyone in the industry is like, look, every company is not just using Amazon. They're using OpenAI. They're using a number of other solutions. And so unlike cloud, where Amazon dominated in the AI wave, they're, I think, in many ways, somewhat behind, and I think they have room to catch up, but they gotta act quick.
All right, Brent Thill, always great to get your insight. Thanks so much for taking the time to join us here this morning.
Thanks.
Coming up on a morning brief, we're going to count you down to the opening bell on Wall Street. Stocks clinching a new record high yesterday. We'll see whether or not that momentum continues. Plus, we will break down General Motors' $5 billion charge the company is taking from its China business. And Foot Locker plunging after its earnings results. We're going to break that down and more. That's coming up on Morning Brief. So now for some of today's trending tickers, let's get to three stocks that we are watching this morning. First up, GM, General Motors operations in China, expecting to take a $5 billion hit. It's part of the automaker's restructuring of its joint venture with SAIC Motor Corp. Then that includes plant closures as well. Most of the costs are expected to be recognized as non-cash. You're looking at the stock reaction here, off just about 0.4% here in pre-market. We know the China business has been struggling a bit. CEO Mary Barra has been very vocal about that, just in terms of the restructuring, Brad, that is taking place and needs to take place at GM. So this is just the latest in the step of what we are seeing, kind of the strategy shift from GM. Lots of questions just about what exactly their presence will look like in the country going forward, and just the ability here. And this is beyond GM, but really all U.S. automakers, the ability there to compete with the domestic players.
Absolutely. Another major company that we're tracking here this morning in the retail landscape, we're watching Foot Locker shares. They've slashed their full year guidance and they missed third quarter estimates, hit by weak demand, consumer demand, and following the busy back to school shopping season. However, they mentioned that the consumer spending trends softened following the peak back-to-school period in August. The promotional event was more elevated than anticipated, or the environment for promotions was more elevated than anticipated. And then additionally here, they are announcing some new multi-year partnerships, really targeting specific franchises, it sounds like. And hey, the Chicago Bulls of Michael Jordan fame will be getting one of those multi-year partnerships here, especially as they kind of lean further into that collaboration with Nike and Jordan brand.
All right, let's take a look at one of the gainers here this morning, and that is Okta. They reported better than expected third quarter results. The cloud-based software provider getting a boost from new products and features. You're looking at gains of just about 13.5%. Lots of focus on the current remaining performance obligations. What exactly that means, that actually came in about 400 basis points above the prior view. This is a bullish sign here for the company moving forward. Much of the reaction on the street this morning was surrounding this. They talk about the fact that the company's suite expansion expansion could be a driver here to upward sales revisions amid some of those easier comps into the new year. So again, a momentum trade to certainly keep in mind as we see some excitement surrounding AI once again this morning.
Big CRPO energy this week here with the current remaining performance obligations. Hey everyone, shares of Dollar Tree moving higher pre-market after its third quarter earnings beat Wall Street's expectations on the top and bottom lines and announcing the departure of CFO Jeff Davis. Let's bring in Scott Mushkin of R5 Capital for more on this. Scott, great to have you here. Just want to get your read in on the Dollar Tree results, considering the tier of consumer that we know that they have gone out to and tried to make sure that they can continue to engage with, even as there's a bit of kind of a pullback in some of the consumer spending at the lower income tiers.
Yeah, I mean, I think that's definitely a factor. I mean, we have a big consulting business, and we started seeing actually almost a year ago that low end consumer pulling back. So almost any retailer you're looking at right now, they're dealing with that. I mean, obviously Dollar Tree is more exposed, but even like a Walmart, they have a lot of consumers there. So I don't think you can blame everything going on at Dollar Tree on just a weak consumer. I mean, if you look at our research, they've struggled in store execution. They struggled to begin with their multi-price point strategy. So there's multiple things going on there. I think the good news coming out of today, and we actually thought the call was quite constructive, is they seem to be getting their arms around some of their personal problems or their internal problems. And I think that's good because I think we believe that they are a very unique retailer, and the retail landscape is definitely changing quite a bit right now. We have a lot of big winners, Walmart, Amazon, and other companies are struggling. You talked about Foot Locker. So, we like where Dollar Tree's positioned. We like what they had to say on the conference call. Its balance sheet's in good shape, and it's relatively cheap compared to where some of the other retailers trade.
Are they able to compete with, I guess, where do they stand just in terms of their ability to compete with some of those larger names like Walmart, like Target, that has been a concern here from the street in the past?
Yeah, I mean, I think it's a big concern across retail because you're seeing Walmart and Amazon take so much share, and I'm going to throw Costco in there. But Dollar Tree is, a lot of their stuff is at $1.25. It's very unique. It's a treasure hunt. It's very hard to replicate that at Amazon and Walmart. And so when we look at what we're recommending, we try to get away from what we call like the nexus of these three companies. And Dollar Tree is away from it because it is a unique format, the treasure hunt, most of the things being $1.25. Mm-hmm. But as you said before, they got a consumer that's not doing that well, but they got their own internal problems from execution, store conditions, store standards. They need to do a lot of remodels, but they seem to be making slow progress that way. And I actually think it's likely to speed up in 2025 as they really get their arms around some of these operating challenges. Yeah. And the potential for real incomes to grow at that low end. I mean, that's obviously one of the big political points that are being tried to drive home is to get some real growth in that lower end.
Scott, we're pressing up against the opening bell. Just quickly, a quick response on the impact of tariffs potentially for Dollar Tree.
I mean, it's a factor. You got to think it's in the stock to a degree. They dealt with 2018 well. And so we think they're going to deal with it well at this time around. But when we say it's in the stock, everyone's worried about tariffs. So almost if it's not as bad as people think, there's some upside there.
And real quick, while we do have you, there's so much to talk about. We have the CFO stepping down. There's the interim CEO. Just in terms of the management changes and what we have seen at Dollar Tree, is that a big concern? And I guess, how do you see Dollar Tree just navigating this?
So, I mean, I think looking at the operating units, they've had new management, not new anymore, in place. We have confidence in the management team that they put into Dollar Tree and Family Dollar. And of course, they're trying to maybe spin off Family Dollar and or sell it. So I do think that the management team is very solid. The interim CEO, I think, got off to a great start on the call this morning. Really, at least for us, instilled a lot of confidence that he's got his arms around this business. So I think it's, generally I would view it as a positive, not the CFO necessarily stepping down because, he had some positive thoughts on Wall Street. But I do think as you look on balance with the management team, it's positive.
And Scott, how should we think about Dollar Tree's, strategy going forward? We talked a lot about the fact that not everything costs $1. They're actually bringing in products that cost $5 to $7. Is that a strategy that you think makes sense given the macroeconomic cycle right now?
It definitely makes sense. I think the question is, how are they going to execute it?
Yeah.
And we were just in about 50 Dollar Tree stores in the last, say, month or so, because we go into a lot of stores. And what I'd say is that they're not where they need to be from an execution perspective on multi-price or a merchandising perspective, although we do think they're learning and doing it better. So that's looking at an equity, it's always about the future, or where are we going? And so we like what some of the slow progress that they are making. We think it will accelerate. But I do think moving to multi-price point now, most of it's still $1.25. But bringing in multi-price point, if you merchandise it right, brings more excitement into the stores, and it should be a very big positive over a 3 to 5 year period.
Scott, great to get your insight. Thanks so much for taking the time to join us here this morning.
Thanks.
We've got the opening bell on Wall Street, and Brad's got a closer look at some of this movement that we're seeing. Brad.
Yeah, we saw Ally Bank ringing the opening bell at the New York Stock Exchange here. There you're taking a look on your screen right now at the Dow Jones Industrial Average. Let me populate this chart here for you, and we'll give you a 3-day look at what's transpired over the past few sessions here. As we're taking a look at the Dow, start off the day fractionally higher. It's up by about 0.4%. The Nasdaq Composite, you're seeing that open up higher, fractionally higher by about 0.6%. And the S&P 500 hitting the trifecta, the hat trick for us here. Whatever you want to call it up by about 0.3%. Let's take a look at some of the heat maps that we've got loaded up. And first, we'll start, as we always do, with a look at the 11 S&P 500 sectors. And as of right now, you've got technology out of the gate strong right now. It's up by about 1.2% to begin today's trading activity. But bringing up the caboose, you've got the materials sector right now. That's lower by about 0.6%. Overall, looks like you've got more laggards than leaders or gainers here on the day. Just about 3 out of 11 in positive territory. Taking a quick look at the Nasdaq 100 as well. You got a lot of green on this screen here. I'll put this on an equal view just so we can get a full measure. And it looks like more gainers than laggards here within the Nasdaq 100, leading the pack, especially off of some of the Salesforce results and a broader lift for the AI trade here and semiconductors. If I can click on this, well, things are jumping around quite a bit, making a bunch of dots, but not really going anywhere. Anyway, it's Marvell. You can take a look at the shares of MRVL. That's moving higher by about 15% to begin today's trading activity here. And for a deeper dive on some of these early market moves as you're taking a close look at the Nasdaq 100, I'll toss things back over to Jared Blickery, who is standing by for a look at what's moving.
Thank you, Brad. Lots of movement here. I just wanted to focus on the S&P 500 as we dial that up behind me. This is that 3-day look. And what I want people to focus on is just, and I'm going to put a year to date actually, is the lack of volatility. The daily range here is just kind of evaporating, and that's good news for bulls. You want to see a boring market. I think this is we've just coming off the lowest 2-day range that we've had since March, and that stat comes via Mike Zaccardi, CMT. But I'm going to skip over bonds 1 second. Just wanted to focus on tech because tech is the only outperformer today, and we're seeing gains across the board. So I'm going to show you the semiconductors first, and semiconductors have kind of flagged over the last month. They've been about break even if you look at the stocks, but here's NVIDIA, that's up over 1%, Broadcom too, and then Marvell, that's the story, that's up 15.5%. Let's get a year to date on Marvell, 83.75%. So that is just a fine breakout that we saw actually just before the election there. And then just sticking with tech, here's software. We see the Salesforce with those results. That's up 8%, giving a little love to Snow and Hubs, each of those up 3%. And we can also take a look at unprofitable tech, unprofitable tech. And if I put this on an equal view where Tesla is not so big, you can see Roku up in the upper left. That's up 8.5%. Unity up 5%, Path up 4%. Block up 3.5%, and the list goes on. And I want to close here with the Mag 7. We just had Meta reaching a record high yesterday. It's down just fractionally today, but here's a year-to-date look. It just broke to that record high. out of a trading range, and we've just seen this, that we've seen a lot of trading ranges break to the upside. And if you take a look at the Mag 7 index itself, not pictured here, that is also hitting record highs. So finally, the Mag 7 kind of catching up with some of those smaller stocks that have really excelled over the last month. Shauna.
All right, Jared, thanks so much for breaking that down. We've got much more on your market action ahead. Stay tuned. You're watching Morning Break. It's time now for a strategy session. A Santa Claus rally is coming for big tech stocks into year end, and we could see another 20% climb coming next year in 2025. That's according to our next guest. Here to tell us why, we want to bring in Dan Ives. He's Wedbush Securities, a senior equity research analyst. Dan, your latest note caught our attention. You're very bullish into the end of the year. You're bullish, to say the least, going into 2025. What are the key drivers of that?
I think it's get the popcorn out, because when you look at the AI party, now it's about the second, third, fourth derivatives playing out. I think Salesforce was the key moment last night. Is, this AI party, it's 10 p.m. and it goes to 4 a.m. I think tech stocks are up over 20% next year as the bears continue to have trouble finding AI in their spreadsheets when they're hibernating in their caves.
I mean, what type of spend do we anticipate continues to make sense, and at what level for some of the early kind of dipping the toe in the water of everything from agent force and what that could mean for companies, all the way into, hey, how much data center space, how many more racks do we need just in order to make sure that we've got enough to run all the inference technology that's going to be necessary?
Yeah, I think you nailed it in terms of that question. Because look, I mean, to me, it's about the multiplier. For every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across tech, across software, infrastructure, cybersecurity. That's why this is going to be a tech bull market that rages into next year. Because now it's about the second, third, fourth derivative. Because now software, they're on the dance floor at the AI party. They're no longer waiting behind the velvet ropes. And now other tech players are trying to get in, cybersecurity, infrastructure. And I think that's what we're going to see, a broadening out of this tech rally in terms of where we see this fourth industrial revolution.
Dan, how much of this is Trump related, meaning the Trump administration returning to the White House, versus that unrelenting strong earnings growth that we have seen? And then, of course, this fear of missing out momentum that certainly seems to be at least somewhat of a factor in these gains.
Look, Trump, it's a Goldilocks scenario for tech. Deregulation, con at the FTC, clearly that's in the last days here. So that's going to be bullish for deal making. I think some of the antitrust concerns are going to start to go away. I mean, they'll still be there in the background. But then you look at $2 trillion of AI CapEx in a deregulatory environment with $6 trillion on the sidelines. And I just continue to say, like, haters will continue to hate. But more and more, you look at this AI spend, look at the use cases, obviously being led by the Messi of AI Palantir, can't deny it. And I think that's why this party is going to rage on going into next year.
You know, as you're thinking about, and you mentioned Palantir, and I was looking at Palantir as we all were in our newsroom yesterday, just trying to figure out, okay, more government contracts, it makes sense. They've already leaned into that and it seemed like there was a setup for that. As you're thinking about the way forward for some of the names that have been, dare I say, culty tech names, but now have real contracts to actually back some of the growth on that trajectory too, how are you kind of evaluating what that runway may look like?
Well, so like when you talk about culty, I think some of it is like retail essentially was ahead of institutional. I mean, you could say that for Tesla, you could say that for Palantir, you could say that for many names. I think the difference now is that the AI revolution is here. And the Messi of AI, Palantir, continue to be front and center. I mean, I think my question on Palantir, I think it's not about this stock going from a teenager to a senior citizen. It's about, could this be the next Oracle, the next SAP? I think that's really the question as we look out. And like, look, we've talked about in the show, the bears have missed every transformational tech day in the last 15 years, waiting for some black swan event, focus on their spreadsheet, and they can't see it in their DCF. That's how they'll miss this AI revolution as well.
Do you think it's the next Oracle?
I believe Palantir could be the next Oracle, and there's nothing that makes me believe it can't be, given where we see enterprise, given AIP, given its special sauce. I don't see anyone else that could compete. And that's our view. From evaluation, you have to look out 3, 4, 5 years. But to deny the AI revolution's happening, that's like being negative against Otani, LeBron, Djokovic. That's where I view Palantir in that category, being the Messi of AI.
The Messi of AI. Dan, really appreciate it. Thanks so much for taking the time here this morning. Always a pleasure to grab some insights. Thanks. Time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at semiconductor tariffs.
That's right, Brad. I'm going to take a look at how the incoming Trump administration could impact semiconductors moving forward through the lens of tariffs here. Let's just give some context. The Biden administration has already imposed several tariffs on chips coming from China. We've seen that hitting 20% on those Chinese semiconductors since 2018 here. That's skyrocketing. But if you take a look at this chart, you'll see that tariffs on other countries have gone down. And that's indicative of a strategy that we could continue to see moving forward here. The idea that tariffs on China will increase, while perhaps we will see a decrease on other countries. At least that's what analysts are hoping, because we do continue to rely on not necessarily these other countries for the chips themselves. Stacey Rasgon over at Bernstein noting that that's only to the tune of about $3 billion of chips that we are importing into the U.S. from the likes of APAC, but it's more about the materials. And we saw this tit for tat between the U.S. and China playing out this week when the Biden administration announced additional curbs on Chinese semiconductor companies. Then Beijing said, well, we're going to ban the exporting of any rare earth minerals to the United States. They export about 99% of the world's rare earth minerals that's utilized in semiconductors. So it's that materials question that is going to be key to watch moving forward. And that is what could potentially have the biggest impact on the semiconductor industry, guys.
All right, Maddie, great stuff. Thanks so much. Coming up, shares of Dollar Tree are on the move after the retailer's latest results. We're going to break that down next.
President-elect Trump is reportedly set to pick crypto enthusiast Paul Atkins to lead the SEC. The former Securities and Exchange Commission commissioner currently serves on the advisory board for Securitize. This is a digital securities issuance platform. Now, Carlos Domingo, the founder and CEO of Securitize, joins us now. Good to have you on the program with us. So how significant is this pick for what is assumed to be a more crypto-friendly SEC that's going to be formulated?
Yeah, good morning. Thanks for having me. So certainly we're very excited about the possibility of Paul Atkins being the chairman of the SEC. I think this is really good for the industry overall, not just necessarily for us, but obviously because he's been in our advisory board since 2019. We know him very well. He's also very actively involved with the Chamber of Digital Commerce, and he's certainly a person that is known for streamlining regulation and being very, pro digital assets and very knowledgeable in the industry.
Carlos, I guess what specific changes or what are you and your colleagues within the industry expecting here if Atkins were to be named SEC chair?
I think the main change that people expect is that we're going to move from this regulation by enforcement that the SEC has been pursuing in the current administration, actually, before it changes, for a more, collaborative framework where, things are being discussed with the participant of the industries, and then more clarity over regulation about, what type of licenses you need, what tokens fall under the SEC purview versus CFTC, et cetera. That provides basically clarity for the industry and a path forward without having to be litigating constantly.
All that in mind, as we're thinking back to the prior Trump administration team and the SEC then that was looking across a crypto industry that was just about to go into its crypto winter and ultimately had the crackdown on initial coin offerings and ICOs and some of the big celebrities that were tied to that. How will this era look different now that you have two crypto winters essentially behind us, where much of that crackdown has already taken out a lot of the major figures that were bad actors and now kind of focusing on building some of the momentum that has gotten us to Bitcoin 95, 97,000?
Obviously, since 2016 till 2024, there's been a lot of change in the digital asset industry and the crypto industry. I think that today the perception of the industry is very different than what it was to be. I tend to agree that the ICO era was very frothiness and with a lot of probably fraudulent activity, and that probably led to that. Lots of those enforcement actions. But I think today a lot of people recognize this is an industry that is here to stay, that provides a very valuable technology base for building a new sort of financial system, and that what we need is regulatory clarity to allow this technology to flourish, and particularly out of the US and not necessarily abroad.
Do you expect to see a significant boost in institutional investment then as a result?
So I don't look. Institutional investors are not going to come in something that they see that there is, regulatory risks, right? So I think one of the things I've been holding the more broader participation of some of the industry actors is precisely being the regulatory uncertainty. So the more regulatory clarity you have, the more institutional participation is going to be for sure.
What additional insurances then would there need to be in order for institutions to feel comfortable recommending to their clients and then piling even more so into digital currencies?
Well, there's a number of things. First, you need to know whether the companies you're interacting with are within the law and that they're properly regulated. And today there is uncertainty because there's many companies in the space that have received well notice or that they're under ongoing lawsuits. I think the other big uncertainty in the industry is which regulator regulates parts of the industry. As you know, there's been this big debate in the industry about whether certain digital assets are commodities or securities, and they will be completely differently regulated by two different agencies depending on where do they fall. And the SEC view has been, we're going to try to regulate everything, and whoever is not agreeing with us, we're going to, send them a Wells notice, which is a preview for a lawsuit or directly engage in litigation, and that has created a lot of uncertainty in the industry.
Carlos, as we wrap this up, just the U.S.'s position then from a global perspective in the crypto market, how significant of a change are you expecting there?
Well, if you think about it, the U.S. is the largest capital market in the world, right? And it's actually the most regulated, but that actually has made it the largest one because it's the safer one for people to participate. So if we can bring the same kind of mentality for the crypto industry, which is, regulated in a way that allow people to participate. Being this the largest capital market in the world, it should be the largest crypto market in the world as well.
Do you think there will be preference towards one particular operator or at least marketplace platform that we see emerge from the U.S., from the government side? As now, over the past couple of days, we've seen some U.S. government transfers of billions of dollars worth of Bitcoin to Coinbase.
Well, certainly in the U.S., Coinbase is the dominant platform today. They are the ones that have been also asking for more regulatory clarity, and as you know, they're engaging in litigation with the SEC about what type of licenses they need for trading the digital assets they trade. I think if you get regulatory clarity, you're going to see more market participants, and competition is always good in the space because it will bring more innovation and more new things that investors can do. So I do think that it will not just be Coinbase, but hopefully there will be many other market participants that will flourish under the new administration.
All right, Carlos, thanks so much for taking the time to join us. Keep it right here on Yahoo Finance. We got much more of your market action ahead. We'll be right back.
Welcome back. We're taking a closer look at some trending tickers this morning, moving on the back of analyst upgrades and downgrades. So let's get to our top calls here. First up, Broadcom is initiated for coverage at HSBC with a hold rating and a $160 price target. The analyst pointing to a couple of headwinds here. Analyst Frank Lee says Broadcom's application-specific integrated circuit business is still one of the key AI revenue growth drivers for this year, but sees revenue growth falling in 2025 despite the addition of 2 new customers. The analyst also saying a further re-rating in 2025 is hard to justify.
M&T Bancorp cut to neutral from overweight at JP Morgan. The analyst team there calling the company's valuation appropriate, and they don't see catalysts for continued outperformance. They are, though, overall positive on the business, saying that the earnings outlook is solid. They do see a large benefit in the new year in 2025 from a roll-off of receive fixed swaps, driving sizable uplift to net interest income. The stock is up more than 50% this year.
And finally, we're tracking semiconductor manufacturer Coherent. It's initiated as a buy at Jefferies, and shares popping on the rating as the analyst, they're saying that the Wall Street is underestimating here the amount of earnings power that it can generate as the new CEO, Jim Anderson, implements his plan to streamline the business. The analyst pointed to the incoming CEO, Jim Anderson's track record at Lattice, speaking for itself. Shares moving higher here in early trading right now.
All right, well, that does it for Morning Brief, but keep it right here on Yahoo Finance. Coming up next is Catalyst. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, ISM services data crossing the wire now. That'll give us the latest measure of economic activity. We'll get you those numbers.
Plus, Federal Reserve Chair Jerome Powell, he is expected to speak today at the DealBook conference. What his comments could signal about a December rate cut.
And stocks extending their gains after jobs data held steady this morning. Big tech also catching a bid. The S&P on track for its 56th record high of the year. We'll tell you how you can position amid the rally.
We're going to get to some breaking economic data crossing the wire. We got the latest numbers out from ISM Services PMI, actually falling to 52.1. That's the latest reading here, just below the street's expectations. You see business activity, that also fell, or we saw a decline there for the month, falling to 53.7 versus 57.2. So a pretty sizable decline if you want to put that in context. New orders also falling to 53.7. We saw unemployment decline as well. Prices paid, though, that actually rose, rising to 58.2. So again, we are seeing maybe a bit of a reaction play out in the markets when we take a look at the bond market at least. But initially here, when you're taking a look at these numbers, November ISM Services PMI here, Maddie, falling to 52.1. And like I said, coming in below what economists had forecasted.
Not only coming in below on that headline number, but to your point, surprising to the upside on prices paid. That's certainly something that's going to be looked at given the question about not just economic activity continuing, but also whether or not that growth picture is going to lead to more inflation moving forward. You could make an argument that that surprise to the upside could potentially be a sign of those inflationary pressures continuing here. That 58.2 also just one tick above that prior reading here on prices paid, which came in at 58.1. And also a surprise to the upside just a bit on employment, perhaps another sign of that growth, especially on the back of data we've been getting about personal income increasing. It'll be interesting to see kind of how the market continues to respond here. As you mentioned here, those treasuries declining after ISM service index sliding a bit this morning. Let's get into the data here. We've got Christopher Hodge. He is the chief U.S. economist over at Natixis CIB Americas, here to discuss with us. Thank you so much for being here, Chris. What's your reaction to this headline number?
Thanks so much for having me. This number is a little bit lower than it was a month prior and a little bit lower than what was forecast, but this is still in an expansionary territory. The strong spending in services is a continuation of a theme that we've seen with the headline being in expansionary territory pretty consistently since the end of the pandemic. This mirrors the economy overall, with spending concentrated on services. And the consumer still going pretty strong. Despite this continued strength, though, we are seeing softness in pockets, especially among those at the lower end of the income segment. In aggregate, consumer balance sheets are pretty strong, but there is some underlying weakness there, and spending is being driven by a narrowing segment of the population. We don't see spending falling off a cliff by any means, but we do think that we're going to see a bit of a slowdown from the observed strength of the past few quarters as wage growth stagnates and savings are run down. You are right to point out, though, the higher print for the prices paid. That should be a little bit concerning to the Fed, because that does confirm a theme that we've seen over the past few months of progress on inflation stagnating a bit.
Yeah, Chris, I'm curious, how big of a risk do you see the upside threat here of inflation heading into the new year?
I don't see much of a risk of inflation reaccelerating back up to 3%, but I do think that there's a significant risk that inflation plateaus at a level uncomfortably above target for the Fed. This has been expressed in some of the Fed speak that we've seen over the past few months, and we do think that the Fed is still on track to cut at the December meeting. But we think it's going to be a hawkish cut. We think Powell is going to signal that the tempo of cuts in 2025 is going to slow a little bit, and indeed we think that the Fed is going to skip in January and then start with a quarterly cutting cadence in 2025.
Chris, what's the level, and I know it's tough to determine at this point, but what is the level for inflation that you think is going to keep the Fed potentially then on the sidelines?
I think if it keeps rounding up to 3, the Fed's going to be uncomfortable with that. And there's a lot of X factors out there, most notably, not one that the Fed's going to mention explicitly, but the policies from Trump. They're broadly reflationary, as stated by the president-elect. And I think that's one of the reasons why it will be prudent for the Fed to skip the January meeting. Trump says he's going to do a lot of things on day one, and there are a lot of things that he has the power to do on day one. Tariffs are one, curbing inflation is another. Both of those things have the potential to be inflationary, and we think it'd be prudent for the Fed to skip in January, assess what Trump does in his first few weeks in office, and then reassess the economic backdrop in March.
How much clarity are you expecting to get from Jay Powell about the path forward today? He is expected to speak. It'll be his last chance to speak prior to that December meeting.
He's struck a very similar tone in the past few months, both at Fed meetings and in other fora as well. So we don't expect a really big change from that perspective. He's going to harp on the Fed being data dependent. He's going to say that the Fed is still going to be vigilant against inflation, but fairly optimistic about the economic backdrop overall. We've got a labor market that's about in equilibrium. We don't see much of an inflationary impulse there. The biggest risk, as I said before, is that inflation continues to hover in that 2.5, 2.6 range. That's uncomfortably high for the Fed.
Well, it's interesting, too, because we've been hearing a little bit of a conflicted message from other Fed members, not necessarily voting members, but this morning, the Federal Reserve Bank president of St. Louis talking about how he sees a greater risk of easing policy too much too soon. Do you take that to heart much in your outlook for the broader voting members of the Fed?
Absolutely. Absolutely. And we have to look at the shift of the composition of the voters come 2025 as well. I think there is a pretty vigorous internal debate at the Fed right now, what the R star is, what the short run R star is, and what the long run R star is. And as long as we have fiscal policy and budget deficits that are running at about 6.5%, and probably going to go up as of 2026 if the Tax Cuts and Jobs Act gets extended and expanded as we think that it will, then the Fed's going to have to reassess what that short run R star is. We're going to get the summary of economic projections at the December meeting. The central tendency of the long-run policy rate for the Fed has continuously gone up over about the past year and a half, and we think it's going to reach about 3% and continue an upward path. So I do think that this is a vigorous conversation that's going on behind closed doors right now at the Fed.
All right, Chris, thanks so much. I want to turn now to the market's reaction to this morning's economic data. For that, we want to bring in Alex Morris, FM Investment CEO and Chief Investment Officer. Alex, it's great to have you here.
Thanks for having me back.
On set with us. We are seeing a bit of a reaction to the services data that we just got out here at the top of the hour. We are seeing yields pull back just a bit from where they were this morning. I'm curious just how you're looking at this mixed econ data, and I guess how big of a driver you see that being within the markets through the end of the year and into 2025.
You know, I think almost it doesn't matter to some extent. It's for equities, it's business as usual. Just keep going up almost in spite of whatever the numbers are. We see it today. If we were to go backwards a year from today, almost every economist was saying there was going to be a recession. They said that the last year. Where was it? Where was it? Where was it? So right now, the stock market in general seems to just kind of shrug off all these numbers and keep going up because there's still folks who want to buy stocks and they want to buy a handful of them that are driving the indices up. But I do think there are some inflationary pressures that we are going to see come into the market. So it is also time to start thinking about where are you? Are you all equities, which probably have some inflation hedge, or do we need to think about a more diversified portfolio when unknown things happen, right? January 20th, Donald Trump's going to take the oath of office, and we don't really know what's going to happen. Are there going to be 60% tariffs? Is it going to be 10, 25? So I think the market is trying to figure out how can it just get as much of a run right now as it can until the unknown and the volatility from that unknown sneaks in February.
What is the appropriate path forward for that diversification, especially given as of this morning, the Mag 7 stocks are up over 60% year to date? You could argue just keep yourself parked there.
Yeah, we like the trend being your friend here. There's nothing wrong with those names, and we've certainly held them at or above benchmark weight, and we don't see any reason why you shouldn't continue to do some of that. That said, we do like to see people pull out to sit some in cash. The short end of the curve is still giving you a nice four-handle return, but also moving out into a little bit investment grade risk and getting a little healthier yield, but also a little bit of duration when rates are probably going to come down. We are going to see a 25 basis point cut I think that's been in the can for the last few months. It's not going to change. There will be some rate cuts next year, whether that's 1 or 4 will be hotly debated, but there's still an opportunity in the debt market that's kind of been overlooked that folks really should take advantage of.
And talk about the timing of that. Is now the time to take advantage of that?
Absolutely. This is those types of trades where when you see it happen, it's too late. Yeah. Because everyone marches in and just rushes out with all that arbitrage. So you want to hang out. Right now, earning 4-ish% on, say, a 2-year corporate bond ETF like Z2 or Z-Tray is a great place to be because you're getting paid along the way while you're waiting for that opportunity to happen. Once you see it happen, you can't move fast enough. The market's already taken it away from you.
And what's the right allocation then? Is it 60-40?
You know, I have to say 60-40, and I get laughed out a lot of rooms for it, but every time someone declares it dead is the first day that thing becomes the best investment you can make. So net, that seems to work. Obviously, folks should get good financial advice, stick to it based on whatever you need to do, but 60-40 is not a terrible mix. It's worked for years. It's still working today.
What do you think is the biggest risk? I asked this to an economist earlier on in the show, and he, to no surprise, was talking about the risk of inflation to the upside. He also talked about an acceleration of inflation. He also talked about weakness in the labor market. But I'm curious, in the equity space, what are you viewing as almost the biggest challenge or headwind here as we enter the new year? Is it current valuations?
So, I mean, certainly as an equity investor, valuations are tough because they're high, and they're not as high as we were in the pre-GFC or .com era. So we've got room to go versus historical. You know, hey, the fiasco light is starting to go off, break glass in case of emergency. But practically from an actual equity management and being a manager of one of those companies, the employment market is still tough. We see numbers move, but reality is, I think folks are taking job postings down, not because they can't afford to hire workers, but because they're fatigued and they can't find the workers to do those jobs at the rates that they can pay, or even higher rates, or keep people in those jobs without having high levels of churn. So from an equity market standpoint, I think many managers saying, how do we just keep the pace of what we're doing going? The consumer still remains pretty resilient. There's certainly a lot of folks buying a lot of chips and a lot of hopes placed on AI that have not gone away. We expect to see some of that bleed through into other parts of the equity market and other sectors this year. And it doesn't seem to be at any pace to slow down. Earnings are still strong. We see the odd miss, but you know, we've had a shift in the market from did you meet consensus to now did you beat that whisper number, which always seems to be kind of unreasonably higher than the actual consensus. So why have the consensus and publish it if we're going to be held to some other standard? And even folks who hit that are given a little bump, but it's not the same 15-20% bump it used to be. So, but life is pretty good if all of these companies are making hundreds of millions or billions of more per year, and people are saying it's not enough. Like maybe we need to reset some expectations of what we're expecting.
Perhaps it's so good that then we start to see it get a little bit bubbly, though, right, to Shauna's point. And I wonder, especially if this does become this IPO exit year, if we start to see a lot of M&A, is that the signal that maybe we've hit the top?
It may be, but that would be great. I mean, the small cap marketplace has just been deprived of the companies that it needs to keep growing. The biggest problem in being a small cap investor is there aren't that many small caps. They become mid caps or large caps. So you're out of fresh supply to invest in because the company's been private for so long. So that may be a signal, but that's probably a signal that you're seeing a peak of private equity, not that you're seeing a peak of public markets.
Alex Morris of FM Investment, thanks so much for taking the time
to
join us. Coming up, we're going to take a look at some of today's trending stocks. We'll give you the news behind those moves. That's coming up next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's with the Yahoo Finance's trending tickers page. First up, let's take a look at GM. General Motors expected to take a $5 billion hit on its operations in China. You're looking at losses today on the stock of just about 1.2%. Yahoo Finance's senior autos reporter, Pras Subramanian, joining us now with more on the impact. And Pras, I guess, what was your biggest takeaway from this news out this morning?
I mean, the big takeaway for me is that huge number. That's a massive hit to their business there in China. We knew there was trouble in the area, but we didn't know how much. And finally, GM now revealed today what it's going to be. So they're going to write down the JV operations in China by 2.6 to 2.9 billion, and then they anticipate another 2.7 billion in charges to restructure the business, which includes plant closures and portfolio optimization. We don't know what that means exactly in terms of the product portfolio, but that's what's happening. Most of the charges will be recorded in Q4 earnings. Now, how bad is it in China? GM lost 350 million in the region through Q3, and sales at their joint venture were down 59% in the first 11 months this year to 370,000 units. BYD sold more than 10 times more cars, right? So I just got this quote from Michael Dunn of Dunn Insights. He's a China expert, auto expert. He said to me, quote, GM had a tremendous run in China, 2 decades of growth, profits in harmony with their joint venture partner. That era is suddenly over. The off-ramp for GM in China is approaching fast. There will be no comeback for GM and many other global automakers in China. So this is devastating sort of news there from an expert. Basically, it's kind of the writing's on the wall. People talk about Ford, they've had to retrench there in China, and a lot of analysts say they need to get out too. So I think that's what's happening, and that could be they might just focus on the U.S. as high profits, et cetera, but China business is not going well.
I thought the slight sort of shade at China, for lack of a better word that's coming to mind for me at this moment, was really interesting too. The idea that it's unclear how they are able to afford to give customers such a cheap counter option. What did you make of that commentary?
I mean, Mary Bear has been talking about this before for a while now, that it's just a dog-eat-dog world. Basically, there's a lot happening in terms of price competition, and they just can't compete with the local automakers there. I think even Tesla is having a hard time there with making their cars more affordable from a price point of view. Because look at BYD. They're selling cars for $12,000, right? It's impossible to compete on that price. So I think that's what's happening with these Western automakers.
All right, Pras, thank you so much for joining us. We really appreciate it. Thank you. Another trending ticker we're watching today, Marvell, reporting better than expected third quarter results, also issuing an upbeat earnings forecast for the fourth quarter. The chipmaker boosted by demand for AI computing. Third quarter profit coming in at 43 cents a share. That was above the 41-cent estimate here. They talk about the real kind of headline coming out of this and why you're perhaps seeing the stock popping over 20%. Demand for AI computing moving forward. The CEO talked about how they've positioned this chip maker to benefit from the boom in AI spend, and that's exactly what you're seeing in the stock performance here. One quote I want to point out from Murphy here saying the exceptional performance in the third quarter and forecast are driven by our custom AI silicon programs now in volume production, which mirrors what we've seen from the other silicon producers in the space in the likes of Amazon Web Services.
Yeah, Maddie, it's certainly a very impressive turnaround when you take a look at the momentum behind this stock, just the year-to-date gains that we have seen, and also just what that growth opportunity still looks like and what it looks like over the next several quarters. We talk about the fact that Amazon is a huge driver here in terms of these results, the sales here of the new customer AI acceleration chips. But beyond that, Google is also using its products looking ahead. Microsoft is also set to use it next year. So we talk about data center product sales doubling from a year ago. And then not only that, their guidance also topping the street's expectations. So again, all around a very solid quarter here from the company and that strength in the AI business. Right now, we're seeing that really offset some of the weakness elsewhere. When you take a look at the auto side of the business, the telecom side of the business, those products seeing some weakness. But again, that unrelenting demand that you were talking about, Maddie, for AI products, and something I know that you have covered very, very closely, clearly paying off for these companies. And as we look ahead to 2025 and we're trying to figure out what exactly the investment thesis and what is going to excite the markets, I think we just keep coming back to that AI story time and time again once you look at these impressive numbers.
It's like the CEO of Amazon Web Services said yesterday, the pie is going to continue to grow. It's not just about NVIDIA anymore. It's about other players in the space because everyone is going to want an AI strategy. So you'll continue to see investment and therefore new product and innovation as well.
Finally, we are looking at Philips, the company facing a two-front battle, slowdown in China, possible looming threats here of tariffs. Joining us now want to bring in Roy Jacobs. He's the CEO of Philips. Roy, it's great to have you back on set with us. So let's start with tariffs. There's a lot to unpack here. I think the big question for investors is just what ultimately this means across various industries. For Philips specifically, how big of a challenge or how do you expect to navigate what could be a very uncertain couple of months or several months?
Yeah, I think for healthcare, and we have, of course, been going through several supply chain challenges following actually from COVID, that we also have been working into how we make our supply chain more resilient and agile, because the situation currently is not clear, which means that we need to be prepared to move fast if kind of clarity kind of comes out. But we already have been working in actually making sure we can source many more products close to our customers. So we did that in the US, we have been doing that in Europe, we have been doing that in China. So in that sense, kind of, I think as an industry we have been working it. As Philips, this was one of the pillars of my strategy, where we said a reliable supply chain is extremely important to be able to cater to the demands in the healthcare market. And I think that's where we see that healthcare still is under very significant pressure. They need new solutions. So I think the healthcare system needs the solutions that we can offer with AI, with the technology and the innovations that we are launching. But at the same time, we need to make sure we can supply them when they need it and from where they need it.
So what is the financial impact if we do see Trump then follow through on the threats here of tariffs? What does that ultimately mean for your business?
Really hard to speculate on. At this point in time, kind of we cannot predict. We make sure that kind of we are best prepared for it, and then kind of we have to take it once there's more clear about this would mean for world situation. But as said, I think we have been also working on preparing for a more regionalized and localized setup of our supply chain. And that's both on components as well as finished products. But it's also fair to say that there is, of course, a global supply chain that you also need to keep working because there are not all components available in any country of the world. So there will always have to be cross-border trade. And that's also what we are advocating for because we believe that's of the interest of the hospitals that actually don't need more burden in terms of more supply chain challenges or higher cost. So we need to make sure that we keep servicing them to the best of our abilities with a reliable supply chain.
There are so many factors here that come to mind for me to ask you about, but one of them is some news that we were covering this morning, the idea that Beijing is already engaging in a bit of a tit-for-tat, banning the exporting of rare earth minerals to the U.S., which is utilized in a lot of products. And I think that's just one example of the wide-ranging impact that this tit-for-tat on tariffs could have. What is your biggest concern specifically about what retaliation could look like?
I think, again, it's hard to predict how it exactly will play out. So that's also why we don't kind of waste time on speculating on that, but we focus our actions on how we can get best prepared. And as on one hand, as I said, regionalizing, but also being agile so that we can adapt. We have been showing that kind of we can do that in earlier situations. I also think that the world has shown earlier kind of what supply chain crisis can do to it and how we need to respond to it. So I think we all need to be very well prepared, focus on the controllable parts that we currently know, which is our supply chain and how we have localized that. And that's making sure in China you can source from China for China. Mm-hmm. In North America, we can actually serve our customers here with North American kind of manufactured goods or supply that actually also comes into the US that actually helps to service them to the best of ability. Because the reliability of the healthcare system is super important. We see massive demand in patient volume that goes up. So there's a very big need to keep that flow of patients going, and therefore supply chains have a very important role to play.
Zooming out beyond the impact of tariffs, one thing I would love to get your take on is kind of how, as the CEO of the company, you deal with just the swings in policy between administrations. You've got 4 years of policy that's completely different coming up here than the policy that we've seen previously. And of course, some of it is a continuation. But how do you think about just the shifting adaptability that you have to have in place given the political volatility that we have?
Yeah, so we have, of course, been working with many administrations, and we have been doing that across our lifetime of 133 years. Mm-hmm. So we keep very much focused on what is it that we're here for to serve. And if you look to the healthcare challenges in North America, for example, the major staff challenges and shortages that exist to support the patients is something that we keep focusing on with our innovations. And by helping and taking AI as some of the latest innovations to really make sure that you have a more productive healthcare system where you can have, for example, Nicholas Hospital that we support in how they treat their children in a better way, but a better patient experience because it's less time of a scan, where they have a more ambient, friendly experience, where we can make sure that the reporting is done in an easier way with the the help of AI. Those are things that we keep focusing on because regardless of administration, that's something we need to solve for as ecosystem. Now, what is important is that you work closely with an administration, and we have been doing that because the ecosystem of healthcare is always how you work the clinical practice with innovations, but also with the regulators and with the administration. So that together you improve patient care in the United States. That's a big topic, high priority for all of us. So that's also what we keep doing. We have very strong ties with the VA, for example, which is very specific patient population that actually we have been serving and actually looking what can you do in remote access. Many of these patients are not close to hospitals, which means we need to dial up remote care. So we come up with solutions, digital, but also kind of specific hardware solutions to serve them in a better way in where they are. And that's something we have been doing already for many years, very successfully also with the government, earlier also already with Trump administration, and with the administration that is in play.
In our final minute here, you mentioned AI. Talk to me about the ROI you're seeing, especially in healthcare. I find that a lot of it is something that's difficult to put a price on, the ability for a nurse to not be experiencing burnout because of AI. How are you seeing it on the balance sheet?
Yeah, we can make it very tangible. So give an example on an MR, which we just launched at the Chicago show. We have a smart speed algorithm that speeds up the time of a scan by 3. Which means that you can double the amount of patients you can support in the hour with the same part of equipment. So actually your return on the investment of that piece of equipment actually goes significantly up. Yeah. We have another part which is actually coming up with helium-3 and AI together, where the TCO, so the total cost of ownership, goes down $400,000 per unit. So we are very focused also on affordable care and how AI actually can help you to become more productive, and therefore actually the measurement is quite tangible. We can measure it with more patients that you can serve on a day, with actually less time that a patient has to experience also a treatment or a scan. So we are looking at real specific measurement. And I give you another example, patient scheduling. Right. 24% of patients do not show up for their appointments. We can actually fill that and help fill faster with AI. That's an immediate return calculation that you can make. So actually AI gives you very tangible contributions, and I think the beauty in healthcare is that AI is already having an impact here and now. It's not something that is there in the next years. We can improve diagnosis, we can improve scan time, we can improve patient experience. And it's going fast. But we need to be aware of the return because not all AI will have its return. So we need to also be looking at the responsible application of AI. AI is a technology that doesn't solve all problems. We still need to have certain hardware developments. We need to kind of collaborate, and we need to do it with the practice so that they can adopt it and work with it in a meaningful manner.
Thank you so much for joining us. We really appreciate it, Roy. Thank
you.
We want to bring you some breaking news this morning. Brian Thompson, the CEO of United Healthcare, United Health Group's insurance division, was fatally shot in New York City Wednesday morning. That's according to reports. United Health has halted its investor day, which was scheduled for today following the fatal attack. Early reports suggest that Thompson was targeted. That's according to Bloomberg. He was shot in the chest this morning outside of the New York Hilton in Midtown Manhattan. Brian Thompson joined United Health Group back in 2004 and has held numerous leadership positions at the company. He was named CEO of United Healthcare in April of 2021. Bitcoin's post-election surge has cooled. The cryptocurrency's price fluctuating right around 96,000 for the past few days. For more on what could fuel Bitcoin's next breakout, we want to bring in Tomas Perfumo. He is the head of strategy at crypto exchange Kraken. It's great to have you here. When you talk about some of the driving factors here of crypto, lots of talk about Paul Atkins likely to be the SEC pick here for President Trump. I'm curious just how big of a catalyst you view that SEC appointment, whether it's Atkins or someone else who is viewed very crypto friendly. How big of a catalyst do you think it's going to be for the industry?
At this point, I don't think from a markets perspective that we'll see a lot of price action in crypto with the pick associated with the specific pick. And that's because the market already expects a pretty crypto friendly pick. I think the more recent news of Gary confirming that he was going to step down in January was like the more let's call it like probabilistic event that ended up completing. And it's really just a matter, I think, of just fulfilling these picks, these appointments that are pro crypto. I think perhaps more importantly, when I think about the SEC, just the more recent news is that all the rumored picks are pro crypto or have a pro crypto stance. And then perhaps more importantly, Scott Bessent, who was the pick for the Secretary of the Treasury, also has a lot of influence because he's pro crypto. He's a confirmed pick, and the Treasury itself is the one that oversees the SEC's function. So I think in general, from a markets perspective, we're already pretty priced in on that front.
So then what is the next big catalyst after that?
Yeah, I think the next big catalyst is really the hard work that's incumbent on the industry. What we saw more recently when it comes to crypto markets, I think, is positioning for a macro environment that we feel is more positive. So that is to say all risk assets, I think, benefit from an environment where interest rates are expected to come down, where you have this kind of pro-growth sentiment and discussion happening across the world, really, but certainly here in the US. And then when it comes to crypto more specifically, with the pro-crypto agenda that we now see, that idea of having legislative clarity that we've been craving for a half decade or more, what it really opens the door is for the industry to go and really show the innovative potential of crypto and to really bring it out to the people. And so what we're seeing is this shift from, hey, how do I bring these crypto solutions without breaking rules, or like what are the rules, and it slows down the progress of innovation. We now see an environment or line of sight to an environment where people are saying, I want to build the next solution, and they go and bring it to market, and then the market will determine whether it's a success or not. So I think really for the next year, the biggest catalysts are going to be the crypto industry proving out some of these applications, whether it's DeFi, et cetera, and showcasing that crypto has something to offer.
And is that going to have I guess, significant impact on institutional investment and involvement and interest? And then I guess what does that then tell us just about wider adoption as well?
Sure. So when it comes to focusing on US and institutional adoption, of course, this year has been pretty landmark because of the launch of the ETF, which ushered in a lot of capital on the sidelines or locked up that couldn't participate previously. So as a simple example, I have a retirement account. Previously, it was very difficult for me to get Bitcoin exposure into that account. Now I can do it through an ETF like IBIT, for example, BlackRock's Bitcoin ETF. And what we've seen this year is that tremendous uptake in the Bitcoin ETF itself. So we've had over 30 billion of net inflows year to date, 8 of which have come in since election day. And so what I think recently happened was you had people who had capital on the sidelines were a little bit iffy on what the US agenda would look like politically with crypto. And now we're seeing that kind of like snap into it. We know the answer. Trump's the president. There's a pro-crypto agenda. I feel comfortable investing in Bitcoin. And so you've had that big pace up in terms of, or acceleration in terms of net inflows from the ETF itself. You've also had other firms like MicroStrategy bringing in about $10 billion of new capital into Bitcoin in the last few weeks alone. And so the price action more recently is digesting that big net inflow, that surge of capital into the industry. When I think about next year, certainly from an institutional perspective, we have some data points, back in the summertime, for example, a BlackRock exec mentioned that 80% of the buy flow they were seeing the activity on their ETF was actually self-directed accounts. That is, you or myself, an individual buying these ETFs. And what I think is going to happen next year is you're going to start opening doors where you're going to have the wealth management industry starting to step in, and even institutional asset managers like pension funds, et cetera, who might look to crypto and start saying, I'm going to allocate maybe even a small percentage, 1 to 3%, say, and that brings in a lot of new capital that still hasn't entered the industry.
I want to get your take on Bitcoin as a safe haven asset before we go, because yesterday it was interesting. We saw a dip in Bitcoin after the South Korean president did declare a motion of martial law, and then, of course, pushed that back and now faces an impeachment motion off of that. But I didn't expect to see those declines, given that this is supposed to be some hedge against geopolitical volatility. What did you make of that move?
Sure. I mean, I don't really associate a Bitcoin move with any specific event, typically speaking. That is to say, like a geopolitical event taking place and Bitcoin trading up or down, to me, isn't necessary validation that it's reacting to that news specifically. When I think about Bitcoin's movements more recently, it's very much tied to like capital net inflows. And so I'm looking at ETF flows. I'm looking at any kind of buying practices coming out of MicroStrategy, for example. They announced that they're doing ATM programs or convertible debt offerings. Also, options activity on IBIT itself has been picking up pace since it launched a couple weeks ago. And so those, to me, are kind of accelerants to big price action movements. And people are really trying to play games or speculate on the level of big capital flows coming in and out of crypto. I think when it comes to geopolitical events, what you really have to look at is the relative activity with respect to other macro markets. So how did equities react? How did FX react? And how did crypto correlate against that activity? And so what I saw more of with respect to that event was more of like a risk drawdown in risk assets in general, rather than crypto reacting a specific way to that event. I think the long-term trend, really speaking, with crypto, at least for the next couple of years, is going to be around this story of like a pro-innovation agenda and what crypto can deliver on that.
Okay, Tomas, thanks so much.
Thank you.
We're going to have all your markets action ahead right here on Yahoo Finance, so stay tuned for more. You're watching Catalyst. Also, a programming note, make sure to tune into Yahoo Finance's Opening Bid podcast for the latest interviews with Wall Street strategists and CEOs. Our own executive editor, Brian Sazi, sat down with the founder of Shake Shack, who weighed in on the future of Starbucks. Take a listen.
Starbucks certainly figured out for years how to say the yes. You want your latte how? And I can't even go through all the permutations, there are so many. And Starbucks figured out the yes. But you can take that too far. And if any strength that goes too far can become a weakness. And if you take it too far for Brian when he comes in with his 18 alterations of his latte.
Well, to be clear, this is 3. 2 espresso shots and a cold brew. I mean, that's
all right,
it.
good. You're easy. But if we take Brian and put him on steroids times thousands of customers.
That'd be scary, yes.
That doesn't work to the benefit of the average customer. And the average customer may have a declining good experience because of all the hospitality we're giving, saying yes.
BlackRock is betting big on the private credit market with the acquisition of HPS Investment Partners. We're going to dive into the outlook for the market with Miguel Souza. He is the head of market research over at Blue Rock. Miguel, it's great to have you on. So talk to me about this investment. It furthers BlackRock's interest in private credit, its third acquisition in that space over the past year here. What does it tell you just about what we're broadly seeing in terms of interest in private credit moving forward?
Yes, good morning. So that's exactly right. As these large asset managers are realizing, the private credit space is growing substantially, and they want to participate in this growth of the private credit space. They also are recognizing that it's very difficult to grow that talent, that management ability in-house. So it might be quicker to get there, to go down that path by acquiring specialist managers that focus in alternative credit or private credit. So I think this acquisition is a great fit for both BlackRock and HPS.
What does it tell us just about, we talk about how there's so much interest, and I think the question right now is whether or not that has peaked, whether or not we're approaching a peak, just what exactly that looks like heading into the new year. But it sounds like you're pretty positive on the opportunity. So I guess just in terms of what exactly is driving that or the fundamental catalyst within that, what do you see as the most likely catalyst here, or why you're so bullish on the space?
Sure. So there's several factors that are making ourselves at Blue Rock bullish on the space, as well as other asset managers. The first is the fundamental change that we've seen in the interest rate environment over the last several years now. Since the Fed started increasing rates a couple of years ago, we've seen higher interest rates now tilt the tables in favor of lenders instead of borrowers. In other words, people can get more yield for their money. Similarly, on the longer end of the curve, call it the 10-year side of the curve of U.S. Treasuries, that's less influenced by the Fed and more influenced by the market. We've seen yields there also go up from their lows of 2s and sub-2s to now 4 and change, between 3.5 and 4.5 in the recent weeks. So that sets a precedent for higher interest rates going forward, even though the Fed has communicated that they're going to lower interest rates. The third factor is that precisely because the Fed has communicated it's going to lower interest rates, but lower them very moderately and gradually over the next year plus, perhaps 2 years, that sets the tables for those companies that are borrowing that don't have such a significant debt burden. And so the peak interest rate environment for those that have, call it floating rate loans, has subsided. So they're able to service that debt, but yet nonetheless, active management is key in that environment because interest rates are higher.
It's a great overview, but it's interesting because one of the kind of scrutinies in the space is that we don't necessarily have a lot of transparency. It's obviously private, right? So I'm curious from your perspective, when you think about the incoming administration and any regulatory changes that could be made, do you think that it's going to be a positive or a negative for the industry that really benefits from being opaque?
Yes, that's an excellent point. The opaqueness of the private credit market in the sense of these aren't publicly traded securities, they're typically held to maturity, makes the documentation behind the loans very important. And so in other words, the lender is going to try to protect itself as much as possible to make sure that in case there is a default, that they're going to be able to recover as much, if not all of their monies back. Nonetheless, the changing administration that we're expecting in 25 and beyond, it's hard to say, really, and try to predict where it's going to go, but we think it will be a slightly more favorable environment for credit investing generally, despite the fact that lenders already do substantial efforts to protect themselves in case of a credit event.
Miguel, you're also heavily involved. You have a REIT, so the exposure there to commercial real estate. I'm curious just to get your thoughts on whether or not we've seen that inflection point and what exactly, I guess, you see driving or helping to recover the CRE market next year.
Yes, so in our view, the real estate market is poised for a very strong bull run. It's had a very challenged 2 to 2.5 years because of that higher interest rate environment. But what's curious is that although price or capital values have come down in that time frame, we've seen net operating income call it the growth of underlying lease rates, grows substantially during that time. So in other words, an investor can now acquire a real estate property or exposure to real estate at a lower price point than 2 years ago, but yet receive more income for that asset that they've acquired. And so that significant growth of net operating income should drive capital values higher going forward. At the same time, the underlying fundamentals are very strong. So we're seeing low vacancy rates or high occupancy rates. We're seeing substantial growth of net operating income, and the cap rate environment or the interest rate environment has stabilized. And so that is different from other drawdowns that we've seen in the past, because the other drawdowns were really driven by lack of demand or excess supply, neither of which is occurring currently. And the last potential benefit for this environment is the perennial fact that real estate is tax advantaged. And so that may also see some benefits going forward because of the changing administration.
Miguel Sosa, thanks so much for your time. Head of Market Research with Blue Rock. Thanks.
Thank you.
Coming up, we're talking the energy demand coming from AI data centers and whether or not it's the biggest challenge when it comes to building out that AI infrastructure. We've got that for you after the break.
Meta continuing its nuclear bid. The company seeks energy partners in hopes of adding 1 to 4 gigawatts of new nuclear generation capacity in the States by the early 2030s. It's all in an effort to fuel the company's AI goals. Angie Gilday from KPMG is joining us now to discuss how hyperscalers are approaching the energy demands of AI. It's great to speak with you, Angie. Talk to me about what you know from your latest surveys over at KPMG about the interest in nuclear specifically, like that we've seen recently from the hyperscalers and Meta, of course, as well.
Yeah, well, we know that the data center business is booming, and so is the demand for energy to fuel that boom. There's about 8,000 data centers worldwide today, and that number is growing every day. And a simple query using ChatGPT takes about 10 times the energy as a regular Google search. So with the scaling up of AI, the energy that's required to fuel that support is really a bottleneck. Nuclear provides a great dense source of energy, but there's also some uncertainties around nuclear, particularly as it relates to public perception, some regulatory permitting challenges, and it does take several years to get those nuclear facilities up online.
Yeah, Angie, I guess to what extent does this then constrain some of the growth that is expected or could be expected within the industry?
Well, the power utility companies were already between a rock and a hard place when it came to energy before the AI boom. They were trying to support the overall cloud consumption demand that was increasing. Plus, you have some really aging infrastructure out there. And with all the challenges with climate-related events and resiliency, it was really stretching the energy providers to continue to provide resilient power. And now with this boom in AI and the demand for energy, it just makes it a lot more difficult in terms of where to place priorities.
Right. I thought it was really interesting that you noted that even though there's all this buzz around nuclear, that's not really where we're seeing hyperscalers be the most bullish. So where are they anticipating to see the most growth to meet this AI demand moving forward?
What we're hearing from hyperscalers is, first of all, renewables is important, and they're willing to pay extra and additional money to get that renewable power. But speed to market is also important, and they need to have reliability and they need to have redundancy. And so I think it's a combination. It's a combination of cleaner renewable sources like wind and solar. Obviously, nuclear is something that is very interesting, but natural gas is also an important part to provide that bridge until other sources can be built.
Angie, is there collaboration maybe between the two sectors when you talk about energy, when you take a look at technology and really what the tech sector wants to see or needs to see just in terms to meet some of that growth demand that they are expecting? What is that partnership or collaboration? I guess, how could they be better working together then to achieve some of these goals in tandem?
Well, that's a great question. And I think this is really a watershed moment for us. We have always wanted to accelerate our energy sources here in the United States. But the big question has been, who pays for that? Does that cost get passed on to the regular consumer? And what we're seeing in this survey is energy companies are willing to provide that, and tech companies are willing to pay. So I think there's a really good opportunity for collaboration between energy providers, tech companies, and the regulators. And it's more about working more collaborative together, understanding where that load is needed and what that capacity is going to be.
Angie Gilday, great to have you here on Yahoo Finance, KPMG's U.S. energy leader. Thanks so much. Keep it right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Hey, our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, stocks racing towards a positive year, of course, here. So we want to talk about how your investments and those plays for 2025 are setting up, and one portfolio manager will share why they think mid-caps are the fertile ground for all you stock pickers out there. Plus, Foot Locker plummeting on its earnings report. We're bringing you the latest on the stock with 3 big takeaways from the company's earnings call. Plus, major U.S. airline CEOs are actively testifying in front of a Senate subcommittee on billions of dollars in revenue of so-called junk fees. We're going to dive into that and the latest coming out of those discussions. But first, let's take a look at some of the market action. We're 90 minutes into the start of the trading day. Stocks are climbing right now as we've got fractional gains for the Dow, the S&P 500, and the Nasdaq. The S&P 500 and the Nasdaq hitting new record highs today ahead of comments from Fed Chair Jerome Powell. Joining me now, we've got Amy Zhang, who is the Alger Executive Vice President and Portfolio Manager, here with us in studio. You're closely watching mid-caps. Tell us why you call them fertile ground for stock pickers.
Well, thank you for having me here, Brad. Yeah, mid-cap I think is really a hidden gem because it's really under allocated, and most investors use a barbell approach, large cap or small cap. But actually, for the last 40 years, mid-cap outperformed both S&P 500 and the Russell 2000. So, I really believe mid-cap has the best of both worlds because compared to large cap, like you said, it's a fertile ground for stocks selection because there's still a lot of discovery value, a lot of inefficiencies there. But because of the size of the company, they typically have higher, growth rates than large caps. And compared to small cap, they're more liquid and have higher financial quality because those companies have already stood the test of time. Mm-hmm. So it's really a very sweet spot to generate attractive risk-adjusted returns for investors.
When you're thinking about small and mid caps, how do you kind of look at the profitability profile for those companies, especially as in aggregate, that's going to kind of range for sure. But then if you were to even look at the S&P 600, that's where you would get that profitability filter if you were to just go in on an indexed approach there.
Oh yeah, that's an excellent question because at Alger we're stock pickers and we care a lot about free cash flow. Profitability is a very important metric that we look at. So the companies we like, typically have very strong cash flow generating capabilities. They generate massive cash flow. So we always want to invest in companies that can control their own destiny. So to that extent, mid cap in general, it's just more attractive than small cap. Because small cap, you clearly as a stock picker, you can pick those companies. The mid cap, you have more, the pool is bigger, so to speak, because those companies have already stood the test of time. They already survived. And structurally, when a company went from small cap to mid cap and then they go on, they typically compound even more value.
Has 2024 measured up to the expectations that we had for small and mid cap companies? And if not, then what are we expecting to be different in 2025?
I think we're just in the beginning, right? So it's really about, it's very, as you know, growth stocks are very rates driven. So the Mag 7 is exception. This year it's been great, but last year, all growth stocks suffered like 22 and 23. But this year the comeback in mid cap is stronger. But as stock pickers, I'm happy to say, we significantly outperform the index because again, I'm very happy to see that we're turning back to, we're coming, we're getting back to a stock pickers market because the macro headwind has turned into a tailwind. But small cap clearly is still, because it's longer duration, right? And to your point, there's a profitability profile. So mid cap, but I think if we use the baseball analogy, I think mid cap is probably in the second, third inning for a lot of our company, and small cap is in first and second inning. But I think for both companies, both asset classes, I think we're really entering a golden age for both small and mid cap in the next next like 1 to 5 years because, valuation being so depressed, right? Like, so especially for mid-cap, for example, currently is trading at a 10% discount to S&P 500. And historically, for the last 20 plus years, it's trading at a 13% premium. And small cap, you even have a wider discount. So to that extent, I think there's a lot of catch up to be done as market will broaden further next year. So I think 25, I'm very excited to see a new cycle for both small and mid-cap stocks.
What would be your top picks as you're evaluating? As you mentioned, your firm is a stock picker's mentality. So what are some of your top picks right now?
Yeah, well, Alger, we just celebrate our 60th anniversary. We consider ourselves the pioneer in growth investing, so we decidedly grow. So top picks, for example, we've been long-term investors of Vertiv. And Vertiv, the reason why we're being long-term investors because clearly it was a derivative, of NVIDIA back in, even last year, right, starting last year. And what they do is they specialize in power management, cooling for data centers. As you know, data center is a very critical, a part of the AI infrastructure.
We could be seeing even more chips in those
data
centers.
Oh yeah, exactly.
So cooling is very
absolutely because they've been doing the traditional air cooling, but now they're also doing liquid cooling. Liquid cooling, you can save even more money. And they have a partnership with NVIDIA, so clearly it's very Blackwell. All those chips are very expensive, so it requires a lot of power management, so to speak. And so for us, this is a very strong secular theme. I think 25, even though stock has done well, I think 25 we're going to see even more revenue and profitability growth in Vertiv because we are at Alger, AI is a very important theme for us. So AI enablers and adopters, and that's really a multi-year, I think, a transformation.
Where does AppLovin? This is also one of your top picks within small mid caps. Where does this kind of fit within your strategy?
That's a great question. So, we always, I've been managing small mid-cap companies for 22 years, December. It's always, even back in the day, I always want to invest in companies that can turn data into actionable information. So it's really innovation is really the key driver I think, is for value creation. So AppLovin is such a company that, we've been invested for a long time. And to that extent, it was really a lot of growth not priced in. So what they do, they are advertising technology platform. It's powered by AI. So they have the best, probably the best recommendation targeting engine called Exxon 2.0. So they're the best in terms of monetizing and inventories for mobile gaming, right? So that's their key vertical growth, has done tremendously well. But more exciting, you always want to, for growth investors, it's always what to come, right? So it's about e-commerce, which is potentially 10 times the market size of that. And we think they will have, significant growth there. So to that, and they generate massive cash flow, and they're buying back a lot of shares. So it's really a very high quality company.
Amy Zhang, thanks so much for taking the time here with us
today. Thank you for having me.
Appreciate it. Well, NVIDIA is one of the top performing stocks of the year, but there are many ways to play the market without NVIDIA. I want to bring in Andrew Skadoff, who is of Bank Creek, as part of this week's ETF report brought to you by Invesco QQQ. Andrew, great to have you here with us today. Bank Creek's U.S. large cap ETF with $89 million in net assets has outperformed the S&P 500 without NVIDIA. How do you pick and choose the right members then of the Mag 7?
Hi, Brad. Well, thanks for having me on the show. Really, our edge at Bank Creek is the development of a robust, systematic deployment of data science to fundamental long-term investing. And it's something that we've been building on for about a decade, although we just recently launched the ETFs that you mentioned. BCUS in particular is our US version. And we're really looking for companies that have specific data signals relating to the quality of their underlying business. And that's how we search and determine to include securities within the portfolio. So to your point, as of now, things like NVIDIA, Meta, and Tesla don't meet our criteria for inclusion, and so they have not been in the portfolio during 2024. But we've still been able to perform quite well just by hunting and searching for these very specific attributes. qualities.
You know, as we think of broader ETF plays and anyone who's trying to make sure that they're tapping into a basket of securities that play into a general theme, what are some of the other ways to play the AI trade without specifically having to have AI touching or semiconductor producing or designing names within that ETF?
It's a great question. And, you know, for us, if you look at some of our holdings today, we do have quite a bit of industrial exposure. And there are some really neat industrial companies that have really been around for decades and decades, in some cases like over 100 years, and they've built very specific edges over time. And so to your point, a lot of these industrials support the build out and development of data centers and AI growth. They're just not going to be the semiconductor plays. So you might have companies like Havel or, you know, like an Eaton, or just companies that are going to be involved in that process and build out. And these companies have done this over all different cycles. So it's really kind of like what's in vogue at the moment in terms of construction and building out across, you know, the US and the world. These companies play a major role without having to be the kind of leader of technology for that play.
You know, as we think about that and the cycle that we're in right now with the Fed, as we're set to hear from Fed Chair Jerome Powell later on today, there are so many different strategies to really approach the ETF landscape as it pertains to what the Fed's policy pathway may look like. Where does that fit within your own strategy, and where would investors be apt to really consider where we are within that policy pathway and set up an ETF strategy around it?
Yeah, so you know, the way we look at investing in general is we take a long-term approach, like many investors do, and we're really focused on the long-term data. And we're using that to determine, hey, this is an interesting asset to invest in. And as far as the Fed goes, we do think, you know, the easing cycle, obviously, longer term is good for public markets. So that should benefit, you know, kind of the entire market in general. But in particular, if you kind of look at the types of companies we tend to own in our ETFs, these companies perform well through all different cycles, which is really important for us. Because we don't want to be, you know, heavily involved in super cyclical businesses that can kind of get whipsawed around. We're looking for the kind of companies that do well across different time periods for our investors.
Absolutely. Andrew Skadoff, who is the Bank Creek Capital Advisors founder and CIO. Andrew, thanks so much for taking the time here with us today.
Thanks, Brad. I really appreciate it. Definitely. Take care.
You too. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now is Yahoo Finance's Akiko Fujita. Akiko, great to see you. First up, we got to talk Eli Lilly. It's rising after finding its weight loss drug Zepbound outperformed rival Wegovy, made by Novo Nordisk, in a clinical trial here. And Akiko, we're taking a look at shares here today, up by about 3.6% on the news.
Yeah, a huge pop we're seeing there on the back of that. Now, you talked about the clinical trials. Those results that we saw pretty much in line with previous results or previous studies that have been conducted pitting Novo Nordisk against Eli Lilly's weight loss drug, going head to head. But the clinical trials, the most concrete evidence that we have seen to date in terms of their outperformance. The trial assigned 751 patients to receive either the drug over a 72-week period. Patients who received Lilly's Zepbound lost roughly 20% of their body weight. That's about 50 pounds. Over the same period, Novo's Wegovy lost 13.7% or 33 pounds. And that points to significant upside for Lilly. We've been talking about these weight loss drugs for some time now. Investors certainly eyeing the market for that when you consider that market is expected to expand to $200 billion by 2031, according to data from PitchBook. All totaled, Eli Lilly said Zepbound provided relative weight reduction that was 47% higher than Wegovy in the trial, and investors really liking that result today, Brad.
Yeah, certainly. All right, another ticker that we're tracking here on the day, Akiko, Chewy. We got to go, I guess, where a lot of pet owners are naturally kind of placing their own mindset and their attention here today. But Chewy is falling despite just narrowly beating on net sales, and they met profit expectations in the third quarter, just barely here. Taking a look at shares, though, they are down, getting hit by about 8% pretty much throughout today's trading session. And one of the things that kind of jumped out to me here this morning, Akiko, was looking at the average order per customer, or the average revenue per customer that they're seeing. And that was a little bit weaker than anticipated, but it also comes back to how this net income story is coming to fruition as well. And it seemed like, at least on an adjusted basis, that was also below expectations here.
Yeah, a number of misses that investors are looking at right now, parsing through that report. You pointed to average revenue per customer coming in lower than expected, as the net income and profit margin as well. We should mention Chewy did raise its guidance for fiscal 2025, with net sales now expected between $11.79 to $11.81 billion. Those declines that you just pointed to, steep declines we are seeing in those shares, the largest single day drop, by the way, since July of this year, despite what we saw a beat on revenue as well as EPS coming in line. We should mention, though, feels like investors are kind of looking at this as a Chewy specific story, looking at where rivals are right now. Competitors Petco and Bark still rising in the session. And we should mention, despite those declines we're seeing today, the stock is up more than 30% year to date, Brad.
Yeah, absolutely. As we're looking at kind of that range where the high was at about $39 this year, or at least over the past 52 weeks, we're sitting at about 30. But that low, that 52-week low, was well off of this, and that was 1468. And so ultimately, to your point, Akiko, still holding on to some pretty solid gains for 2024. Thanks so much, Akiko. Appreciate it. Investors appear unhappy with Foot Locker's third quarter results here. Shares, they have been hit hard and lower by 9% right now as consumer spending weighed on the company. Here's what the CEO, Mary Dillon, had to say on the company's earnings call.
In the quarter, we saw consumers remain cautious with their discretionary dollars. More specifically, this translated to shoppers concentrating spending around the peak back-to-school selling season in August, and then pulling back in September and October, which we believe reflected consumers holding off on spending ahead of holiday events. Looking to the fourth quarter, we expect our customers to remain cautious with their discretionary dollars and to consolidate their spending over peak periods in the holiday season. We also expect the elevated promotional activity we saw in the third quarter to continue through the holiday season.
Here with her takeaways from these results is Christina Fernandez. She's a managing director and senior research analyst at Telsey Advisory Group. Christina, great to have you here with us. I mean, increased promotions that are anticipated to continue to run, and then additionally a consumer that might be a little bit more judicious about what new kicks they want to buy, or what they're going to be playing basketball or running in, or perhaps just trying to complete an outfit.
Yeah, no, you're correct. A couple of things, I think, on Foot Locker's report, and the third quarter was weaker than expected, and the fourth quarter is going to be weaker as well. We're seeing the consumer pull back outside of key selling seasons. We've heard that from other retailers as well, but it was more pronounced at Foot Locker. For example, they said August back to school was up high single digit, but then September, October were down low single digits. So that was a factor. Then you're also seeing Nike, which is 60% of their sales, their demand for their products be softer, and that sort of reverberated across the industry. Nike has been offering higher promotions. The retailers have had to respond. So the combination of all those things led to weaker sales, more promotions, and then Foot Locker having to lower their outlook for the year, which is a step back given that they are a turnaround story and have made several initiatives to improve the business, but now it's a step back here in the back half of 24.
What does that tell you about the consumer right now, Christina?
Yeah, I think the consumer's really picking where they want to spend their money. So, Nike, some of their products are not as much in demand as they were. And then you're seeing them purchase other products. For example, they said sales of Adidas, On, Hoka, New Balance, all those other brands combined were up double digit. But when Nike is your biggest, the bigger player in the industry, then it waits. So it's really a very picky consumer, and they are just buying the things that they, that they want to buy. And if not, they're just passing and moving and purchasing other things.
How critical is Foot Locker right now, especially as you think about the brands that had gone more D2C after decades of their wholesale strategy and their retail partnerships, and then we saw an omni-channel approach, and then we saw trying to pull some of those relationships into their biggest, the customers that want to engage with their brands the most, pulling that closer to the vest, and now it seems like we're seeing a little bit of an unwinding there where they're trying to chart new strategies with Foot Locker. What is the timeline for the companies to be able to see benefits from that, for Foot Locker and the Lace Up plan to also see benefits, and for customers as well to really see a difference?
Yeah, I mean, you are seeing some of it. For example, for brands like On and Hoka and New Balance, Foot Locker, and also Dick's, are really important to the ecosystem. In what when Nike pulled back from Foot Locker, it really gave these brands an opportunity. It really helps when consumers are shopping at the mall to see the product face to face. So I think that that is working, and Foot Locker is seeing double-digit gains in those brands. So I think it is important. I think as far as like the DTC for the brands, it really varies by brand and more on the momentum. So you are seeing a shift back to wholesale from DTC for all the brands, but then at the same time, different brands are growing at different rates, and there are different phases of their life cycle on the key products.
I walked in the 34th Street Herald Square Foot Locker a couple weeks ago just to look at the new remodeling. And this is something that also got a little bit of a nod in the store-based update portion of Foot Locker's earnings release, talking about the new stores that they've opened, but also the amount of stores that they're closing that seems like it's continuing to outpace the new store openings. Plus, you've got mass remodelings that are taking place as well. What is the reality of the new in-store experience that Foot Locker's trying to drive, making sure that it also passes through to shareholder value and a differing customer experience?
Yeah, I think it is. They are making changes like what you saw on the 34th Street store, but there's only 6 stores that have that format. So as a percentage of the portfolio, it's still small. The refreshes as well, these are minor refreshers, so better fixtures, just better positioning of the product in the store. And they just started this year, so they're going to do 400 this year, but there's still more to go to 2025, 2026. So I still think it's early days on seeing, the stores being better and having that be a significant driver for Foot Locker on the turnaround. I think where we're seeing more progress, it's really on the brand diversification, and then the other areas of the strategy where we still want to see more improvement is really the omni-channel improvement, and then also loyalty, like the penetration of consumers that are part of the loyalty program is still pretty low compared to what we see from other competitors.
Which brand has the most to gain, and then on the other side, perhaps a brand that has the most to lose if Foot Locker's strategy, that is a multi-year plan that they've laid out to investors, doesn't play out correctly?
I think if the strategy doesn't play out, I would say, those dollars will go to competitors. For example, Dick's Sporting Goods gaining a lot of share. So it would really be other retailers out there. I feel like all the brands would probably lose from Foot Locker. Obviously, Nike is where they have, it's the biggest partnership. But for all the brands, having less distribution points would be a negative.
Certainly. Christina, thank you so much for taking the time here and giving us some of the key takeaways from the call with Foot Locker. Appreciate it.
You're welcome. Thank you for having me.
Coming up, a look at the latest labor market data with ADP's chief economist. Stay tuned. Private payrolls grew by 146,000 in November, according to data from ADP. The latest sign of a slowing but resilient labor market ahead of Friday's jobs report from the Bureau of Labor Statistics. Neela Richardson, ADP chief economist, joins me now live in living color in studio. Thanks so much for taking the time here today.
It's great to see you in person.
Always know it's a busy day when you have the national employment report that you're releasing here. And within the private employment and private payrolls data, I wonder what stood out to you the most, especially as this comes as a precursor to the monthly jobs report from the Bureau of Labor Statistics.
Oh, Brad, that's a great way to kick off this report. There's actually three things that really stand out to me. One is manufacturing weakness. We've seen that consistently for the past 2 years. Unfortunately, November was no exception to that. We're still seeing that weakness, and that was met with some good hiring on the services front, but still not the energy in some of the sectors like leisure and hospitality that we've grown accustomed to. The second thing that stands out is large firms did the bulk of the hiring. 120,000 of that 146,000 came from employers with more than 500 employees. That's something to watch as we look at interest rates and the effect on the small firm hiring. And the final thing to watch, and this is really important for the Fed, we saw wage growth tick up a bit in November. And that's meaningful because we're still trying to get to that 2% inflation. Right now, wage growth is still much stronger than it was pre-pandemic, and that might foil the best laid plans towards 2% inflation.
You saw my eyes light up as you started to discuss some of the pay insights. As usually is part of this report, cyclically, pay gains, they accelerated in November, as you mentioned here, but year-over-year gains for job stayers versus job switchers. What are you seeing there in some of the dynamics?
First of all, they both picked up. So we moved from 4.7 to 4.8 for job stayers. I know that doesn't sound like a lot, but to me, what it's suggesting is that we're stabilizing at just below 5% in job stayer wage growth, and that's pretty strong wage growth. The second thing to note is that job changers pay went from 6.7% in October to 7.2%. Why is that important? Well, job changers, as we all know, are the most sensitive to real-time labor market conditions. So if they're getting paid a little bit more in November than they did in October, that tells you that there's a labor market out there that's still a little tight. And that is meaningful to the Fed.
What does this all mean then for the Fed, especially as it seems like the probability is pointing towards a rate cut, as we've had in discussions here with economists on Yahoo Finance, looking for a cut in December, and it sounds like even looking out into 2025, we could see one cut per quarter.
I think it means that they still have to be vigilant and not preset, because the data could turn pretty quickly. You could see this inflationary decline. I guess that's called disinflation, not an inflationary disinflation trend continue. But we also saw in the previous month that inflation has been sticky. And so as long as you have sticky inflation and strong wage growth, you can't be on a preset course to cutting rates, because that could come and bite you later. So I think they're still going to be very cautious, very data dependent. It doesn't mean that they don't cut in December, and in future months in 2025, they'll be more deliberate and, to use a football term, more likely to call an audible based on incoming data than we've come accustomed to with the Fed.
I like that. You know, just lastly, while we have you here, we've got an incoming administration that's really been focusing on efficiency, and it seems like that's starting to rattle through the mindsets of businesses. Is that starting to show up among private employers to you at all right now?
I think it's too early in terms of efficiency, but just writ large, employers are always thinking about efficiency. Their most important attribute is their capital, their labor, their workforce, and they're always thinking about how to make their workforce more productive. So this is kind of how corporate America thinks. It looks like it might be heading to the government now too. So we'll be watching and waiting to see how that all plays out there.
Neela, great to see you. Thanks so much for joining us in studio today.
Thanks for having me.
Absolutely. Let's zero in on some trending tickers here. American Airlines, Delta, and United. Executives from major U.S. airlines and low-cost carriers, Frontier and Spirit, are testifying today in front of the Senate Subcommittee on Investigations over billions of dollars made in, quote, junk fees. U.S. Democratic Senator Richard Blumenthal, chair of the subcommittee, released a majority staff report that talks about how these airlines have used ancillary or junk fees to boost their revenue, resulting in higher costs for you, the consumer. The airline executives all made opening statements at the hearing defending these fees as necessary to provide customers with choice. Take a listen.
Our ancillary fees support the availability of optional services and ensure that customers who don't need these services aren't subsidizing others.
Our model ensures that customers only pay for the services they want, not what others want. Optional services, by definition, are not so-called junk fees, as optional services are not required to travel.
We are proud of the customer-friendly, transparent, and voluntary nature of our fee structure. Any American passenger can fly on any of our flights at any time without paying any fees at all.
We'll be keeping close tabs on any stock price movements, of course, for all of those airlines that are present here, as we were taking a look at just a few of the activities of United Airlines, American Airlines, Delta Airlines, Spirit as well here. Coming up, everyone, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We're 2 hours into the trading day and it's time for Yahoo Finance's Market Minute. Stocks are solidly in the green here. We're seeing the S&P and the Nasdaq notching record highs. Here are 3 trending headlines that we are watching today. Investor Stanley Druckenmiller's Duquesne family office sold 95% of its Palantir stake, according to its 13F filings. Unsustainable valuation multiples have fueled profit-taking. And Chipotle is raising prices by about 2% nationwide to offset inflation. Truist analysts cite strong November traffic and manageable costs in raising their price target for the stock. And America's top fashion brand of 2024 is Nike, according to YouGov's annual survey, especially with men and Gen Z, but third after Skechers and Old Navy for women. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. More wealth when we return.
Over the past 5 decades, advanced micro devices, or AMD, has become a staple of the tech industry. Let's take a closer look at the semiconductor company's biggest moments with Beyond the Ticker. AMD was founded in 1969 by Jerry Sanders and a group of 7 other individuals. The company went public on September 27, 1972 at $15.50 per share, bringing in a total of $7.5 million. In 1982, AMD and Intel signed a 10-year technology exchange agreement as part of a deal to supply chips to IBM. In 1991, AMD released the AM386, its version of Intel's 386 microprocessor, leading to a legal battle between the two companies. AMD landed a major deal in 1994 to supply AM486 processors to power compact PCs, an unheard of move at the time. 2 years later, AMD purchased NextGen for $857 million in stock to take on Intel's Pentium line of chips. In 1999, AMD introduced the Athlon processor, the first 1 GHz microprocessor, and in 2003, the company launched its Opteron chips for network servers. AMD acquired longtime NVIDIA rival ATI Technologies for $5.4 billion in 2006, pushing ahead into the graphics card business for high-end gaming and design PCs. In 2009, Intel agreed to pay AMD $1.25 billion as part of the pair's long-running antitrust battle. In 2013, Microsoft and Sony chose AMD as the chip provider for the Xbox One and PlayStation 4 game consoles. In 2017, AMD debuted its new Ryzen line of chips aimed directly at taking on Intel's top-of-the-line offerings. Then, in 2023, AMD acquired open-source AI software provider Nod.ai to boost its AI capabilities. Behind the AI wave, AMD hopes to continue riding this momentum well into the future.
It's that time of the year, folks. There's holiday cheer, family and friends to see, food to eat, presents to buy, and all that shopping could be a little easier with a holiday bonus. Here with more on what to do with your holiday bonus is bank rate analyst James Royal. James, good to have you here with us. You have 5 smart money moves here. What's the first?
Yeah, it's a great time of year. You got the money from that bonus, top off your IRA account, and then we're so close to the end of the year, you can flip and do the 2025 as well. You'll be able to, in 2024, sock away $7,000 if you're under age 50 and an extra $1,000 if you're 50 and over. And it's a great way to get tax-free or tax-deferred retirement savings.
Now, one of your other tips really talks about and looks across assessing your bills and your emergency funds as well, perhaps building up that coffer. What's the advice there?
Yeah, so a lot of people are behind on credit card bills, and certainly with the holidays coming up, a lot of people are going to be spending on credit cards, and that's a great place if those are costing you 25-30% per year. That's a great place to pay down those bills, and it's a guaranteed return. And so it's guaranteed. It's risk-free. You're not putting it in the market where it's subject to ups and downs. And that's a great way to stay ahead. And many Americans are so far behind on bills that it offers a great return and guaranteed. And then, we've also got, if you need those emergency savings, it's a great time for a high yield savings account. Those accounts are paying well above inflation, and that buffer can help you in tough times. There's lots of expectations that we may be seeing inflation in 2025. Certain economic policies are passed and go into effect. And so having that buffer is going to be really effective. And then on top of that, just that buffer allows you protection to keep your other investments in the market and working for you if we do see continued upside in the coming year.
Let's talk about investing too. What are a couple investing moves that you could potentially make with a bonus?
Yeah, so one is 401k. So if your employer offers a retirement savings plan, it's a great way. You can't put that money directly into that plan, but you can use that as a buffer for the next few months or early into 2025 and increase your contributions to that retirement plan. And that will allow you to invest in higher return assets such as stocks and stock funds. And then the extra little bonus there is that if your employer offers you a match on your contributions, then you can get some risk-free money added on top of that. So that's a great addition. And then the S&P 500 has had a fantastic year in 2024, and it's been one of the best years ever. That's great, and you might feel tempted to sort of load that bonus into the market all at once, given what we've seen, and even good projections for the year ahead. But take a step back, use dollar cost averaging, and continue that investing discipline in an index fund like the S&P 500, based on the S&P 500, and invest that over 6 months or a year so that you're not market timing and putting it all in the market at one point, but reducing your risk by investing over time.
James, this is all cool, calm, and collected, but let's be real. What if I just want to go buy something?
Why not? I mean, take that portion. You've worked hard all year for that bonus. Take some portion of it and go buy something special. But here's an ideal time to get ahead on that savings while you have that money, and you don't have to make those hard efforts to squirrel it away every paycheck.
Is there a way to smart spend to ensure that even if I am going in and splurging on something, that I'm also making sure that maybe it's something that kind of brings me value later on down the line too?
Yeah, absolutely. And I think one of the ways you really consider what's going to bring you joy, what's going to be an investment and something you can spend time with over a longer period of time. But, part of it is, I think, you limit the amount that you spend of that bonus and then commit to that savings later on. Nobody's ever going to say, oh boy, I wish I didn't have this money that I'd saved in the past. Everybody's going to appreciate having that money later on too.
That's a great point. James Royal, thanks so much for taking the time today. I appreciate it.
Thanks, Brad.
Holiday season, you may be interested in how much money you're actually pocketing. Keep in mind, Uncle Sam will still take his cut of your holiday bonus, and you may notice that the money seems to be subject to a whole different withholding rate. You're not wrong. There are two methods for how much your employer withholds in taxes. One way takes a flat percentage, typically 22%. If you receive your bonus as part of your usual paycheck, it will face your normal withholding rate. If you're lucky enough to get a bonus over $1 million, hey, remember your friend Brad. But also remember that all funds over the first million are taxed at 37%. What you actually pay in taxes on your bonus won't be determined until you file your return at tax time. Then, if it turns out more of your bonus was taken out than necessary, you could get a refund for the excess withholding. You can reduce the amount your bonus is taxed by editing your W-4, contributing those funds to an IRA or 401k, or even asking your employer to defer payment. In addition to income tax, bonus payments are subject to Social Security, Medicare, and federal unemployment taxes. And depending upon where you live, you might also have to pay state or local taxes. There are some types of bonuses that are not taxed, including gifts like food or tickets. But cash and even gift cards are always taxable. Coming up on the other side of this short break, we're talking about the rise of gaming on the go as developers make smaller, portable consoles. That's next on Wealth. Gig work is part of our modern freelance market, with sites like Fiverr and Upwork serving as a go-to place to source jobs. But on the newest episode of Living Not So Fabulously, founder and CEO of Gritty in Pink says these types of sites are inequitable for women, and that's why her company is focused on helping skilled and talented women level up. Take a listen.
Women make 50% less on these digital platforms like Fiverr and Upwork, and it's because they're underpricing their services. We are underpricing our services. So we're developing tools like an AI fair pay scale and other tools to, help freelancers and women get paid what they're worth, women and non-binary professionals, and also help these venues and companies and artists, staff female talent, because it's not a pipeline problem. I call like it is. Women are there. Women are talented. Women are skilled. It's just because we don't always have, the access, the boys club. We don't, everyone's like, I got a guy, we don't always get access to these opportunities. And so that's what InPink is all about.
You can catch more of Living Not So Fabulously every Wednesday, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. It's time now for Tech Support, our weekly segment dedicated to all things technology. And this week marks the 20-year anniversary since the release of the Nintendo DS, one of the best-selling consoles of all time. And this comes as smaller consoles are more popular than ever. I want to bring in Yahoo Finance's resident gamer and expert, Dan Howley. Dan, how did portable gaming make such a comeback here?
First of all, 20 years makes me feel really old, because I remember that coming out and playing like Nintendogs on it. All those dogs are probably dead now, because I haven't played that game in forever, but they're not real.
R.I.P.
R.I.P. But portable gaming is really kind of taking off in a big way thanks to the Nintendo Switch. They launched in 2017, and it's become incredibly popular. It's one of their best-selling consoles ever now, one of the best-selling consoles, period. And so that really kind of set people up to say, well, why can't we just do this on the go? Apple going big with mobile gaming, proving that you can run these high-end games on small devices has been huge. Now, the Switch is still going. Nintendo's going to launch a sequel to it. We don't know what it's called. We're just going to call it Switch 2 for now, next year. That console, the original Switch, is running an old NVIDIA chip that, it's nothing right now. It's nowhere near as powerful as what's around today.
Will there be a new chip?
There's going to be a new chip. I mean, they have to, if you look at games on it now. But it's not just Nintendo. Everybody's seen the progress that the portable gaming has made there. So a lot of companies, Valve, which owns the Steam Marketplace, big gaming website where you can purchase games, Lenovo, Dell, they've all launched these different kind of portable PC gaming systems where you can play via Windows or you can play via what Valve calls its Steam system, the Steam Deck. I have one of those. They're really great. You can play PC games on the go. The battery life, not super great, but I could still plug it in and get going. And then Sony has its PlayStation Portal, which connects directly to your PlayStation over the internet. You need your PS5 and the system. It's $199. You think, ooh, do I really want that? They just started going with cloud beta. So basically, you'll be able to play this all in the cloud. And that's kind of where a lot of this is leading to, where you'll be able to play these games anywhere in the world. And that, for these companies, is a big deal because it means that they'll be able to get gamers who normally wouldn't be able to afford a $1,500 PC or a $700 console or $600 console. They'll be able to get them and then meet them there at a good price point. The $199 for that portal, you sign up for a PlayStation subscription, you're able to play cloud games wherever you want now. Microsoft leaning in more towards Game Pass, their cloud system. They want to make sure that that pays off with their Activision Blizzard acquisition. Part of that is getting cloud gaming to everyone's hands. So they're working with these developers of these small PCs to get those to run Game Pass. So it's just going to continue to explode from here.
But it seems like it's the same names that are really circling the industry right now, is it not? Who are some of the big players who are reportedly rumored to be working on smaller consoles right now?
Yeah, so Microsoft has long been rumored to be working on one. They have their Xbox line of consoles, obviously. It's not doing so hot this console generation when it comes to, matching up with Sony. And Nintendo always kind of does its own thing, but it just turns out that that own thing really blew up and is now insanely good for the rest of the gaming community. So Microsoft has been thinking about this. As I said, it fits in well with their whole Game Pass strategy, and that's going to be where they see gaming going. It's going to be that, as well as getting Game Pass on your iPhone.
Why not just the device you're already carrying around?
Well, so that's the ideal, right? Play wherever you want. Apple doesn't really see it that way. They want you to play Apple Arcade games. So they make it so that you can't download the Microsoft Game Pass app. However, they pushed really hard in court to support the idea that, look, it's a closed system. It shouldn't be this way. Open it up. We never did anything like that. Wink, wink, nudge, nudge. But they're trying to get Game Pass onto the iPhone, onto Android phones. And so that'll really open it up for a lot more users around the world. And then, as I said, that Activision Blizzard acquisition, those billions of dollars are going to start to pay off once they can do that. And they get gamers all around the world who don't have PCs or consoles.
Dan, excellent breakdown here. We got to leave it there. Yahoo Finance's own Dan Howley with the tech support. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up 3 p.m. Eastern Time.